Hello, welcome to JK classes. Today we are going to discuss RTP of May 2024. I'm Professor Nihit Jhaveri. We will be discussing RTP applicable for May 2024 attempt for paper 4, direct tax and international taxation. Direct tax law and international taxation, which is 100 mark subject. You have your attempt in May 2024, but this video can be used for not only May 24 attempt, can be viewed by those who are appearing in November 24 attempt as well. 6 months before the first date of your exam, that is 31st October 2023, whatever circulars and notifications that have already been published by government up to 31st October 2023 will be applicable to you. Circulars, notifications, etc. issued up to 31st October 2023. Many people call me up and ask me that, sir, till what date we have to study circulars? So answer is till 31st October 2023. The budget which was announced on 1st February 2024, due to year of election, it is vote on account, or you can say interim budget. That budget is not applicable for your attempt, neither for May 24 nor for November 24. Starting with RTP, this RTP has 20 questions. Out of 20 questions, 13 questions are in the form of MCQs and 7 descriptive questions requiring theoretical answer or requiring practical calculation based answer. We call it as descriptive question. Out of 13 MCQs, it is divided into 3 parts. Case scenario based questions are 2, case scenario 1, case scenario 2. Case scenario 1 has got 6 questions, case scenario 2 has got 4 questions, and then there are some loose MCQs, 3 loose MCQ, that is how 13 MCQs, 7 descriptive questions. Right now I'm starting with case scenario number 1. Case scenario number 1, in exam also you can expect similar type of question. These case scenarios and MCQs, or rather all the 20 questions, focus on clarifying the applicability of latest amendments applicable for AY 2024-25. Okay, starting with the first one. First one is based on question number 1, that is case scenario 1, which has 6 MCQs. Case scenario 1 is based on TCS chapter, tax collection at source. While discussing the question, I'll show you some theoretical part of section 206C, subsection 1G. You will have clarity about the applicable provisions. The following pertain to Mr. Sahil and his best friend Mr. Akil. 2 different assessee. They have purchased some foreign currency. You have to decide whether tax will be collectible or not. Under section 206C, subsection 1G. As far as Mr. Sahil is concerned, he has remitted some amount to his elder son Arav. Now, his elder son Arav, what is his name? That is immaterial. Who is pursuing 2-year MBA program from Columbia University, USA. Okay. So this is a story of Sahil. Number 1, out of savings through HDFC Bank. Now before we proceed further, let me show you some provisions of 206C1G, which is divided into 2 parts, subclause A and clause B. Clause A, clause B. Clause A is applicable when the seller is authorized foreign currency dealer, authorized under FEMA. And clause B is applicable when the seller is travel agency, tour agency, etc. selling OTPP. Person who is the seller of OTPP, Overseas Tour Program Package, OTPP, like Kuoni Travel, Sita Travels, Cox and Kings, etc. And here authorized dealer. Here there are 3 possibilities and here there is only 1 possibility. 3 possibility. Number 1, in case if you are purchasing from him, this person is selling it to you, foreign currency. He is selling you for payment for out of India, payment for higher education out of loan. Payment for higher education out of loan for the purpose or loan from financial institution referred to in section 80E. Then TCS will be at 0.5% on amount exceeding 7 lakh. In case you are purchasing, he is selling foreign currency for medical purpose or educational purpose other than the educational purpose covered by point number 1. If it is for higher education purpose out of loan taken from financial institution, then category 1. TCS rate will be 0.5% on amount exceeding first 7 lakhs. Point 2 or category 2, you are purchasing from authorized dealer for any purpose being education or medical, but education other than out of loan taken from financial institution, then the rate is 5% on the amount exceeding 7 lakhs. Or if you are purchasing it for purchase of OTPP, Overseas Tour Program Package, you are purchasing foreign currency, you are traveling abroad, you are buying it from authorized dealer, then provisions have been changed. Up to 30th September 2023, it was 5% on entire amount, on full amount. And now 1st October 2023 onwards, it shall be 5% on first 7 lakhs and 20% on amount exceeding 7 lakhs. And in case you are buying foreign currency from seller of OTPP, then straight away just like this, up to 30th September 2023. Up to 30th September 23, it was 5% on amount exceeding 5% on full amount. And now from 1st October 2023, it is 5% on first 7 lakhs and it shall be 20% on amount exceeding 7 lakhs. This is how the provisions were discussed in the class. These provisions will have to be applied. Now CBDT issued a circular clarifying that for the purpose of higher education outside India from loan taken from financial institution, the qualifying amount is 7 lakhs. For any other education or medical purpose, again it is 7 lakhs. For 7 lakhs, no TCS. However, it will not be 7 lakh plus 7 lakh plus this 7 lakh. It will not be that way 14 lakh or 21 lakh. The overall limit is 7 lakh rupees. So in this question, MCQ 1, 2, 3 out of total 6 MCQs based on case scenario 1, you will have to apply this provision. What is it? We will discuss, but first let's glance through it quickly. Clause A, authorized dealer receiving amount from you. Either it is for remittance for higher education out of loan obtained from financial institution referred to in ATE. Then no TCS on first 7 lakhs, TCS will be at the rate of 0.5% on amount exceeding 7 lakhs. If it is for medical treatment, category 2, or it is for education other than the educational loan from financial institution referred to in point 1, then first 7 lakh no TCS and above 7 lakh 5%. Here no changes have been made, it was like this. However, in case from the authorized dealer authorized by RBI under LRS scheme, liberalized remittance scheme of RBI, if you are buying it for purchase of OTPP, then no limit is applicable. Earlier also no limit was applicable. 1st October 23 onwards also no limit applicable. Earlier it was 5% of the whole amount. Now 1st October 2023 onwards, first 7 lakh 5% and above 7 lakh it will be 20%. And in case you are buying, clause B, in case you are buying from authorized dealer for any other purpose other than the above, clause A only, first 7 lakh no TCS, you are buying not for medical or you are not buying for education, nor are you buying for purchase of OTPP, you are buying for any other purpose, maybe for gifting purpose or investment purpose, then up to 30th September 2023, it was 5% of whole amount. 1st October 23 onwards, 5% of whole amount above 7 lakhs. First 7 lakh no TCS. 1st October 23 onwards, first 7 lakhs no TCS, above 7 lakhs it will be 20%. And in case you are buying it from OTPP seller, then no qualifying amount, entire amount will be subjected to TCS. 5% of the whole amount up to 30th September 23, on or after 1st October 2023, it will be 5% for the first 7 lakhs. Above 7 lakhs it will be 20%. Okay, now based on this we have this case scenario 1. Let's start with Sahil. There are two people involved, Sahil and Akil. Sahil has remitted, his son is studying in USA, Columbia University, out of own savings through HDFC Bank, an authorized dealer under liberalized remittance scheme LRS of the RBI, towards tuition fees on 5th July 2023. 3,50,000. Now here he has not taken any loan. Understand which category would it fall under? It wouldn't fall under category 1, it will fall under category 2. Category 1 and 2, both of them have the same qualifying amount, first 7 lakhs no TCS. However, if it falls under category 1, that is if it is for education, tuition fees, but out of loan taken from financial institution referred to in ATE, then the TCS rate will be 0.5%. Otherwise here loan is not involved, from financial institution, TCS rate will be 5%. 0.5% or 5%, that's the only difference, whether taken through loan or otherwise by way of loan. To meet day-to-day expenses for study purposes, day-to-day expenses, on 10th May 2023, 1,20,000, 29 September 23, 90,000, 1st January 24, 1,35,000. So how many transactions we have glanced through? We have glanced through 4 transactions through HDFC Bank. Assessee is not Sahil. Technically HDFC Bank will be the assessee for the purpose of collecting tax and remitting it to the government account. Then through Axis Bank, authorized dealer under LRS, again authorized dealer, loan towards tuition fees. Now loan towards tuition fee, this would be eligible for 0.5% exceeding first 7 lakh. First 7 lakh no TCS. On 11th October 2023, 3,50,000, and on 10th January 24 again 3,50,000. Total 7 lakh transacted through Axis Bank sent outside India towards tuition fees, but it is basically for repayment of loan towards tuition fees. Axis Bank is one of the financial institutions referred to in section 80E. So these two transactions, if TCS is attracted, then TCS would be at the rate of 0.5%. Own savings, then remitted out of own savings to meet day-to-day expenses. The purpose is day-to-day expenses, 1,50,000 on 1st July 2023. Okay, so he has 4 transactions through HDFC Bank and 3 transactions can be seen here. 3 amounts are there, 3 transactions through Axis Bank. Transaction number 1, 3,50,000 through HDFC Bank, and 3 more transactions given on this page. Total 4 transactions through HDFC, 3 transactions you can see here through Axis Bank. And then 5,20,000, one more transaction. To complete the formalities of admission, Mr. Sahil visited the USA from 10th April 2023 to 13th April 2023. He personally visited, for which he purchased tour package from Messrs. Gate to Travel. It's for purchase of tour package, foreign travel. Here no qualifying amount, no first 7 lakh, everything will be subjected to TCS. Here if the transaction took place up to 30th September 2023, the date plays an important role. If the transaction is up to 30th September 2023, entire amount would be subjected to TCS at 5% rate. If the transaction took place on or after 1st October 2023, then first 7 lakh 5%, above 7 lakh 20%. 5,20,000, that is what he paid to Messrs. Gate to Travel, a foreign tour operator, and remits money under LRS on 5th April 23. This is the date. 10th April 23 to 13th April 23 is the date of travel. 5th April 23 is the date of payment. International travel and ticket and hotel accommodation are included in the said package. Okay, so this 5,20,000 will be considered separately. Now here it is not being mentioned whether he purchased through Axis Bank or HDFC. Whichever bank he might have made payment to, he has made payment for purchase of tour package, whereby payment is made to Messrs. Gate to Travel. Therefore, this will fall under clause B, 206C subsection 1G, clause B. No limit, no qualifying amount, straight away entire amount will be subjected to TCS. Date is 5th April, 5% of the entire amount. Mr. Sahil has furnished undertakings containing the details of earlier remittances. Let me clarify once again, as I told you, the 7 lakh rupee limit which we talked about, that 7 lakh is not for each seller. It's not that I purchase from HDFC Bank, first 7 lakh no TCS, then tomorrow I purchase from Axis Bank, again 7 lakh no TCS, day after tomorrow I purchase from another bank, again 7 lakh. I cannot keep on having 7 lakh limit for each and every person from whom I purchase. 7 lakh limit is a yearly limit. Whenever you go to purchase any foreign currency, you will have to give undertaking about your previous transactions in the current year. So now, as stated in the question, Sahil has furnished undertaking to both the banks containing the details of earlier remittances in the same year to HDFC Bank and to Axis Bank. Some transactions, if you see in a chronological order, if you arrange them date wise, then one transaction is with HDFC, another with Axis, another with HDFC, another with Axis. In such situation, we will have to analyze properly. He has also furnished his permanent account number to the authorized dealers and to the seller of overseas tour program package. PAN number is provided. Therefore, TCS will not be attracted at a higher rate. If you recollect, without PAN number of the buyer, TCS will be at twice the rate applicable or 5%, whichever is higher. That concept will not apply here. Okay, then there is a story of Mr. Akil. But before we jump to Akil, let's finish off questions, MCQs pertaining to Sahil, so we can solve it easily. So things are fresh in our mind. Question out of 6 MCQs pertaining to this case study. It says, from the information given above, choose the most appropriate answer to question number 1 to question number 6. First 3 are for Sahil, last 3 are for Akil. Number 1, is HDFC Bank required to collect the tax at source on the amount remitted by Mr. Sahil? If so, what is the amount of tax to be collected? Is HDFC Bank required to collect the tax at source? Okay, so with HDFC Bank he has 4 transactions. Friends, the best way to solve this question is to rearrange all the transactions right now in 3 partition in the form of what transactions took place with HDFC Bank, what transactions took place with Axis Bank, and what transactions took place with Messrs Gate to Travel. We will have to rearrange everything not according to the seller but according to the date. How many transactions are taking place, if you can see? Now dates are relevant only for the purpose of those transactions where 7 lakh threshold limit is applicable. Next transaction to meet D2 tax, this is 3,50,000. We will be chronologically arranging them. Next transaction 10th May, 29 September. I am writing down all the dates, then we will arrange them. 10th May, 29 September. 29 September 2023. Then what to do? 3, and the 4th transaction is 1st January 24. 1st January 24. However, in order to check whether 7 lakh rupees of qualifying amount is being exceeded or not, we will have to arrange not only in a chronological order, not only the transactions with HDFC, but we'll also have to merge the transactions of Axis Bank. Now, some of you might be wondering that how HDFC will come to know about transactions with Axis. Answer, assessee, that is Sahil, will have to give an undertaking. In case he gives false undertaking, then what? In case he gives a false undertaking, then if whenever caught, he will be penalized. Income tax department will come to know and he will severely be penalized. Okay. Then 3 transactions, 11th October 23, 10th January 24. 11th October 2023, 10th January 2024. And then thereafter one more transaction, 1st July 23. 1st July 2023. This last transaction, 5th April 2023, this I am not taking into account for the purpose of arranging them in a chronological order. Why? Reason is, this particular transaction is for purchase of OTPP, which will not have any qualifying amount. Since qualifying amount is not applicable to this transaction, it is pointless to take it into account. This entire transaction will be subjected to TCS 5%, no 7 lakh. 5,20,000 into 5%. Depending upon whether question has been asked based on this or not, we will see. Okay, now, okay, so how many transactions? 1, 2, 3, 4, 4 transactions with HDFC and 3 transactions with Axis. These 7 transactions we need to organize in a chronological order. So out of so many dates, which date comes first? If you can see, May, January, October. Okay, this date comes first. 10th May 2023 is the first one. After May, there is June, July, 1st July, second transaction, 5th July, third transaction, if you can understand. Thereafter July, then August, September. September, this will be 4th transaction. Then October. October has only 1 transaction. This will be the 5th transaction. October, then after November, December, January. 1st January, 6th, and 10th January, 7 transaction. So out of total transactions, first 4 transactions are with HDFC. So what I have done is I have already calculated it out and kept it ready for you in a chronological order. Or what else you can do is that you can give the numbering here. 10th May 2023 is the first transaction. Thereafter, second one is 1st July. This is the second transaction, 2nd July. I hope you are understanding why we are doing it like this. Third transaction is 5th July. This is the third transaction. Then fourth transaction is 29 September. 29 September is the fourth transaction. Then 1st January is a sixth transaction. 4th October is a fifth transaction. 10th January is a seventh transaction. All of them are chronologically organized. Okay, and now what I have done is I have converted into this in this tabular form in a chronological order, along with the name of the bank and along with the amount in the amount column. So now what is the question? Question is, question number 1, is HDFC Bank required to collect the tax at source? Collection would be under 206C1G. With HDFC Bank there are 4 transactions. Let's understand. 4 options are given to us. Okay, so in a chronological order, first transaction, let's see whether when is the 7 lakh limit getting exhausted. All these 7 transactions are eligible for no TCS on first 7 lakh. So out of 7 lakh, first 1 lakh 20 is gone. Remaining amount left out is 5 lakh 80. Then 1 lakh 50. 580 minus 150, we still have 4 lakh 30,000 left out where no TCS would be collected. 430 minus 350. We still have 80,000 left out on which no TCS. Out of this 90,000, first 80,000 no TCS, 0. 0 TCS, 0 TCS, 0 TCS. And balance 10,000 will be attracting TCS. Now this 29 September transaction, let's see whether it is for repayment of loan for higher education or attracting 0.5% or it is other way around. 29 September transaction is for meeting day-to-day expenses as given here. Day-to-day. Then TCS rate will be 5% on this. This will be attracting TCS at the rate of 5%. Then that is HDFC Bank. So first transaction with HDFC Bank, no TCS. Second transaction with HDFC Bank, again no TCS. Third transaction with HDFC Bank on 29 September 23, first 80,000 no TCS. With first 80,000, 7 lakh threshold limit or qualifying amount gets fully exhausted. Remaining 10,000 will attract TCS at the rate of 5%. Next transaction is with Axis Bank, 3 lakh 50,000. Next transaction, right now we have a question on HDFC. So now HDFC on this 1 lakh 35,000, TCS will be attracted. Now 1st January 24, what transaction is that? Let's understand. 1st January 24, again for day-to-day expenses, so this will attract 5% TCS. 1 lakh 35,000 into 5%. And the last transaction is with Axis Bank. So as far as HDFC is concerned, we are being asked to answer first transaction no TCS, second transaction again no TCS, third and fourth transaction will attract TCS. However, in third transaction on 29 September, TCS will be attracted only on 10,000 at the rate of 5%, and on 1st January 24 transaction, again 1 lakh 35,000 into 5%. So this will be TCS here would be 10,000 into 5%. Let's see what are the options available to us. Okay, yes, 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 and last one is no. No will definitely a wrong answer. TCS is certainly attracted. 29 September, 29 September, 29 September, 1st January, 1st January, 1st January. Dates are correct. That means out of 4 transactions, last 4 transactions are going to attract TCS. Okay, that is correct. All the transaction will have 5% TCS. So answer is going to be 10,000 into 5% and then 1,35,000 into 5%. Let's calculate it out and we will be able to find out our correct answer. 10,000 into 5% is 500. 500, 500. So option A is a wrong option, 2000 on 29 September. And then 1,35,000 into 5%, 6750. 6750 on 10 January. C is the correct answer. Let's check whether this is the correct answer or not. Where is it given? Answers are given after 13 MCQs are over. C is the correct answer. Okay, coming back to our that was our first question. Okay, C is the correct answer. Our answer is correct. Now coming to question 2. Is Axis Bank required to collect the tax at source on the amount remitted by Mr. Sahil? If so, what amount? As far as Axis Bank is concerned, again the same thing. We have 3 transactions of Mr. Sahil with Axis Bank. Which 3? Number 1, number 2 and number 3. Out of these 3, the 7 lakh limit gets exhausted here. Now out of these 3, last transaction number 5, 6 and 7 when arranged in a chronological order, Axis Bank 3,50,000, we'll have to see what is the purpose, and Axis Bank last transaction 5 and transaction 7 both will be attracting TCS. These 2 transactions are for what purpose? Axis Bank 3.5 lakh, 3.5 lakh, both the transactions are with regards to loan towards tuition fees. Both of them will attract 0.5% TCS. 3.5 lakh into 0.5%, 3.5 lakh into 0.5%. So here this will be much easier to solve. Okay, 3.5 lakh, which 2 dates? 11th October 2023 and 10th January 2024. 3,50,000 into 0.005, 0.5%, 1750 on both the dates. So answer will be, first seems to be wrong answer, 7,500 and 1750. Then 1750. First A option says 3 transactions TCS on. That is the wrong answer. First transaction will not attract any TCS out of 3 transactions with Axis Bank. Second, TCS of 17,500 is wrong. That will be based on 5% rate. Third is yes, 1750 on 11th October and again 1750 on 10th January. This is the correct answer. 1750, 1750. And last one is no taxes required. That is certainly wrong answer. Let's check whether C is the correct answer or not. Answer for the second question also, C is the correct answer. Third question for Sahil again, and then last 3 questions will be for another person, Akil. Is tax required to be collected at source on the amount remitted for tour package to USA by Mr. Sahil? Here the amount is being remitted to Messrs. Gate 2 Travel, 5,20,000. This 5,20,000 remitted on 5th April 23 will have no threshold limit. Entire amount will be subjected to 5% TCS. If so, what is the amount to be collected? Answer 5,20,000 into 0.05, 26,000. First is the correct answer, option A. Option A is the correct answer. Our answer is correct. Okay, now we have 3 more questions for another person, Akil. As far as Akil is concerned, we have one paragraph. Mr. Akil, an Indian citizen, got a job offer from Messrs. Wellbeing Incorporation, a Dubai-based company. Akil, Indian citizen, he got job offer from Messrs. Wellbeing Incorporation, Dubai-based company for UAE Emirates, 10,500 per month, which is a good offer. He left for Dubai on 29 March 23. 29 March 23, that means in financial year 22-23, last year. Last year, that means assuming current year, he is out of India. And he joined Messrs. Wellbeing Incorporation from 1st April 2023, that is financial year 23-24, AY 24-25. He returned to India on 15 December 23 on leaves for 15 days. Okay, so ever since he joined that Wellbeing company, he has not been to India for almost 8 months. He directly came to India on 15 December 23. Okay, now are we required to compute his residential status or determine residential status? Answer yes. Provisions of TCS as per CBDT circular, provisions of TCS under section 206C1G on purchase of foreign currency or rather sale of foreign currency is not applicable in case if the buyer is a non-resident. Buyer is non-resident, then concept is not applicable. TCS is applicable at the time of purchase or at the time of receipt. Notification number so and so dated 30th March 22. This I had told you in the class that many people are not aware of it. Provision shall not apply to individual who is not a resident in India and is visiting India. So we'll have to first find out his residential status. So let's understand 15 December 23 came to India. On 23rd December 2023, that is after 8 days, he went on a 7 days tour to Bali with his wife and son. So again he is leaving India. So 15 December, 16, 17, 18, 19, 20, 21, 22, 23. 9 days he is present in India. Definitely non-resident. Let's see whether he again returned back to India or not. Thereafter he directly went to Dubai from Bali to Dubai with his wife and son on 16 December 23. That is the day on which he entered India. Next day, he purchased a tour package for Bali from Make Your Trip, an Indian tour operator, for which he paid 7,50,000 Indian rupees to purchase the dollars towards flight tickets and hotel accommodation. During financial year 23-24, so this 7,50,000, whether this will be subject to TCS or not. During financial year 23-24, he has business income of 4,20,000 from a retail shop in India. Business income of 4,20,000 from retail shop in India. Now details about Indian income given. If you recollect residential status concept, there were three categories of individuals. One of the category was Indian citizen who whether comes to India or does not come to India, if he is not liable to tax in any other country. If he is not liable to tax in any other country and his Indian income is more than 15 lakh rupees for the given year, then he will be deemed to be resident and he will be deemed to be RNOR. Let's see how much is his Indian income. So he is present in India for 9 days that we calculated. Under this category, person should be citizen of India, that he is. He should not be liable to tax in any other country. And third condition is his Indian income should be more than 15 lakh. Let's calculate. Indian income right now is 4,20,000 from business. Interest on fixed deposit and savings account with Canara Bank. Interest on FD is 120 and 8,000 is 8,000 rupees is Canara Bank savings account interest. So that makes it 1,28,000. Total right now is 5,48,000. 5.48. He is not liable to pay tax in Dubai. So under that category, he will become resident in India, deemed to be resident. He will be RNOR if three conditions fulfill. First is he should be Indian citizen, that condition he has fulfilled. Second, he should not be liable to be taxed in any other country, that condition is also fulfilled. However, third condition, in order to become resident, his Indian income should be more than 15 lakh. Indian income is 5,48,000. He does not fulfill that condition. He will be still non-resident in India. Non-resident for the given year. And as far as non-residents are concerned, they visiting India, if they purchase foreign currency or tour package, foreign tour package, overseas tour package, then TCS is not applicable to them under section 206C1G. Okay. That's it. Assume 1 AED is equal to 23 rupees. Okay. Now since he is non-resident in India, we don't require this foreign currency conversion rate because his income outside India, 10,500 AED per month, that is not going to be taxable in India. So it will be pointless to convert from Emirates from their currency to Indian currency. It will be pointless. Okay. What is the question? Question number 456. Question 4, does Make Your Trip, is it required to collect tax at source on the amount received for tour package to Bali from Mr. Akil? Answer no. Why no? Because he is non-resident as per circular, as per notification. Notification of government dated so and so, number so and so. No need to remember the number, remember the concept. Okay. If so, what is the amount of tax to be collected? My answer is no, tax not required because he is non-resident. Why is non-resident? We just checked it out. Option A, B, C are yes, yes, yes. Option D seems to be the correct option, no tax. Let's check whether this is the correct answer or not. Answer for fourth question, D is the correct option. Next, what is the total income of Akil for the AY 24-25? Total income, naturally we are talking about Indian income. We are necessarily not talking about his global income. Therefore, 10,500 dirhams, UAE dirhams, that is not to be taken into account. And that 23 rupee exchange rate also is to be ignored. Of Mr. Akil for the AY 24-25, what is the total income? Total income, assume he has shifted out, opted out of default tax regime under 115 BAC. Now how much will be his income? His income will be simply, he has got only three incomes. PGBP income 4,20,000. Total income is 5,48,000. However, as per 115 BAC and without 115 BAC subsection 1A, without 115 BAC subsection 1A. So as far as business income is concerned, business income would remain same, 4,20,000, 4,20,000. No changes to be made whether he is opting for normal or opting for this. Thereafter he has got 1,20,000 FD account interest, that will also remain same. 8,000 rupees of savings account interest, that will also remain same. Total is 5.48, 5.48. However, where will it make a difference? It will make a difference in 115 BAC. He is opting for this option, normal tax regime. He is shifting out of 115 BAC subsection 1A. Under section 80 TTA savings account interest, assuming he is non-senior citizen. He is non-senior citizen. 80 TTA deduction, 80 TTA is available to resident also and non-resident also, but only with regards to savings bank account interest. Under 115 BSc subsection 1A, in case he would have opted, then 80 TTA would not have been allowable. But if he is shifting out of 115 BSc subsection 1A, then 8,000 deduction is allowable. His income would be 5,40,000 under this option and 5,48,000 under this option. Which option is he opting for? Normal. He is shifting out of it. Therefore, 5,40,000 is the correct answer. Let's check what are the options available. 5,40,000, D is the answer. D. Let's check whether D is the correct answer. Yes, D is the correct answer. Okay. First three options, or at least option 1 and option 3, seem to have taken into account his global income. Then 6 and the last MCQ for this case scenario, what would be the amount of tax liability? Now they are asking about tax liability of Akil computed in the most beneficial manner. Understand, question 5 and question 6 both are independent of each other. For question 5, they have very clearly stated that he is shifting out of 115 BSc. Same assumption not to be applied for option 6 or question number 6. Question 6 is independent of question 5. So whatever is stated in question 5 is not forcibly to be applied for question 6. So in question 6, he might opt for 115 BSc because question is saying most beneficial manner. 115 BSc subsection 1A is available for residents also and non-residents also. Or Mr. Akil. Okay, let's check out what will be the tax liability. He is non-senior citizen. Under 115 BSc subsection 1A, income would be 5,48,000, but tax liability would be first 3 lakhs no tax, 0, and balance 2,48,000 will be attracting tax 5%. How much would be the tax liability here? Here tax will be 12,400. Of course, plus health and education says. And in case he opts for normal provision, shifts out of it, then out of 5,40,000, first 2.5 lakh being young person, no tax, next 2.5 lakh 5%, 12,500 would be the tax, and balance 40,000 at the rate of 20% would attract 8,000 tax. So here tax liability would be 20,500 and here tax liability under 115 BSc would be 12,400. 12,400 plus health and education says 4%. We'll calculate it out. 12,400 into 1.04. 12,896. 12,896. So out of 2,500 and 12,896 or 12,400, 12,400. Either options would be given to 12,400 or option will be given to 12,896 or institute might round it off and give you 12,900. Any of the three options would be given to you. 12,400 is also correct answer, 12,896 also, and 12,900 rounded off figure is also correct answer. Let's check what are the options given to us for the tax liability. 12,480 and 12,900. The answer 12,900 is the correct option. 12,900. Why 12,900? Because answer is 12,896 rounded off to nearest multiple of 10 rupee. B is the correct answer. 6B. Our answer is correct. That's it. With that, case scenario 1 comes to an end. Now case scenario 2. Case scenario number 2 is based on public charitable trust. Public charitable and religious trust. We know pretty well 11%. Section 11 के हिसाब से 85% of the income can be claimed exempt. First 15% will always be exempt. What is it? Seva Niketan, a charitable trust registered under section 12AB, runs an educational institution which is engaged solely in education, and it runs a hospital. They are running educational institution also, they are running hospital also for treatment of persons suffering from mental disorder solely for philanthropic purposes, that means free of cost. The trust furnished the following information. Now Seva Niketan is the name of the associate trust which is running educational institution as well as hospital. The total receipts of the trust for the previous year 23-24 for educational institution is 3.10 crore and for the hospital it is 3.4 crore. 3.1 crore plus 3.4 crore totaling to 6.50 crore, 6.5 crore or 6.50 crore. Now for educational institution, exemption is possible under section 1023C subclause 3 AD And for hospital, exemption is possible under section 1023C subclause 3AE. This exemption is possible only if the combined gross receipt for the whole year does not exceed 5 crore. Here the combined gross receipt exceeds 5 crore, it is 6.5 crore, therefore it is exceeding 5 crore. Therefore, exemption under 1023C clause 23C subclause 3AD and subclause 3AE will not be available. Okay. Second, voluntary contributions. Voluntary contributions included in this 6.5 crore included in one above received during the previous year 23-24 from public amounted to 105 lakh. So out of 6.5 crore, public contribution is 1 crore 5 lakh, remaining amounts are collection from running education institution or hospital. It includes that 105 includes corpus donation of 55 lakhs for purchase of building of the trust and anonymous donation of rupees 20 lakhs. So the bifurcation of 105 lakh will be 55 lakh corpus, 20 lakh rupees anonymous donation, and remaining 30 lakh will be others. Out of them, this 20 lakh rupees which is anonymous donation, we know pretty well section 115 BBC will be applicable, read with section 13. Section 13 and section 115 BBC. According to section 115 BBC subsection 1, out of this 20 lakh rupees of anonymous donation, some amount is not chargeable to tax at 30% and balance amount will be taxable at a flat rate of 30% according to 115 BBC. How much is not taxable at 30%? The answer, lower of the following two, either 1 lakh rupee flat or 5%, 1 lakh flat or 5% of total donation. Total donation is 105 lakh. So 5% of 105 lakh, which will be 5 lakhs and 25,000. 5.25 lakh, whichever is higher, not lower, whichever is higher. Higher of the following two will not be taxable at 30%. 5.25 is the higher. So out of 20 lakh rupees, 5.25 lakh being higher of these two is not taxable at 30% flat rate, but will be merged with other regular income and will be subjected to that 15% 85% concept. 14.75 is the balance amount left out. This will be taxable at a flat rate of 30%, which we will calculate if required. Third point, during the previous year 23-24, computers purchased. Now purchase of computer, which is an asset, amounts to application of income. Though it's a capital asset, since it is acquired for the approved objects of the trust, it will be considered as application of income. Purchase for 80 lakh rupees, but let's see what is the source of 80 lakh. 80 lakh out of corpus fund mentioned in point number 2 above. Point number 2 is here and corpus mention is 55 lakh. So out of 55 lakh rupees of corpus fund, 30 lakh rupees of corpus fund is misutilized. If you can understand, being misutilized, it will be taxable at a flat rate of 30% under section 115 BBI. 30 lakh rupees, entire 55 lakh rupees of corpus donation is meant for acquisition of building for the trust. Instead of purchasing building, if it is utilized for acquiring computer, even though computer is for the purpose of the trust, then also since acquired out of 30 lakh rupees of corpus donation, it will be considered as misutilization. This will be taxable at a flat rate of 30%. I am writing with a different color pen so that we can identify it at a later stage. This will be taxable at 30% flat rate under section 115 BBI. 115 BBI introduced recently with effect from AY 23-24. You need to remember that. Okay. Now proceeding further. So computers acquired for 80 lakh rupees. What is the source of acquisition of 80 lakh rupees of computer? 30 lakh from corpus, which will become taxable at 30%. Loan 25 lakh. Amount of loan utilized to acquire computer will be considered as application of income, but not right now. It will be considered as application of income in the year of repayment of loan. Anything which is incoming loan is not an income, and anything spent out of loan will also not be considered as application of income. Incoming loan is not an income. Amount spent out of loan cannot be application of income. When can it be application of income? The amount is spent for the approved objects in the current year, computers are acquired in the current year, but the loan is repaid later on, then whenever it is repaid in that year it will be considered as application of income. So this is not an application of income. Even this amount 30 lakh rupees of corpus fund utilized will also not be considered as application of income. It would have been application of income if it was spent, 30 lakh rupees was spent for acquiring computer out of regular donation, not out of corpus. This is misutilization of corpus. Out of 80 lakh rupees, 30 lakh is from corpus, 25 lakh rupees is from loan, and remaining 25 lakh is from voluntary contribution. 30 plus 25 makes it 80. This will be considered application of income. Then fourth point, corpus donations. Corpus donations are how much? Corpus donations are 55 lakhs. Corpus donation is 55 lakh. Out of corpus donation of 55 lakh rupees, received during the current year are invested in. Now, according to section 12 subsection 1, section 12 subsection 1 clause D, read with section 11, corpus donation will not be regarded as income and will not be taxable provided corpus are invested in specified modes of investment specified under section 11 subsection 5. We know pretty well. So, corpus donation received during the current year are invested in post office savings account 10 lakh. This is correct. This is one of the specified modes of investment. However, investing corpus into specified modes of investment on its own does not make it application of income. Corpus is not an income only, and if corpus is invested somewhere, that will also not be regarded as application of income. But if corpuses are not invested in specified modes of investment, then corpus donation will become chargeable to tax. Canara Bank as fixed deposits, FD with scheduled bank, Post Office Bank is fine, Canara Bank is a scheduled bank, that is also fine. But this is not application of income. It is just that this will make investing in so and so will make the corpus donation exempt as per 12(1)(d). NBFC and NBFCs are not one of the specified modes of investment. Therefore, this amount, what will happen to this? This will become chargeable to tax at a flat rate of 30%. I am writing with a different colored pen so that we can identify it easily at a later stage. This will be taxable at 30% rate under section 115 BBI. One of the most complicated chapters of the entire CA final, charitable trust. Government also doesn't know what they have introduced. Okay. Now next point, fifth point, deposited 15 lakh rupees towards post office savings account which were utilized for purchase of building during earlier years. So current year 15 lakhs are deposited into post office savings account but were utilized during 2021 and 21-22 out of corpus fund of 10 lakhs and corpus fund of 5 lakhs respectively. It's a very complicated point you need to understand. This is based on one of the amendments carried out in AY 22-23, financial year 21-22, AY 22-23. What is it? So it states that corpus when received, it is not chargeable to tax, it is exempt. Anything spent out of corpus. So first of all, when corpus is received, it will have to be invested in specified modes. If it is not invested in specified modes, like invested in NBFC or not invested, then in that year itself it will become chargeable to tax at 30% rate. So that means the trust must have in 2021 and 21-22 10 lakhs and 5 lakhs totaling to 15 lakhs were the corpus donations of the given year. They were invested in post office savings account and whenever received they must have been invested in post office savings account, and in 2021 and 21-22 they were withdrawn from post office savings account and were utilized in purchase of building, which is towards one of the approved objects of the trust. But in the year of purchase of building, this 5 lakh and 10 lakh would not have been considered as application of income. They will be considered as application of income in the year in which amount is redeposited back into corpus fund, redeposited back into post office savings account. Redepositing back into corpus is done in the current year 23-24. So for example, corpus were received in financial year 18-19. Corpus is not an income, gone. Now corpus is in financial year 18-19, corpus must have been invested in specified modes of investment. Then only it would have been exempt at that time, assuming they were invested properly. Now in 2021 and 21-22, funds were withdrawn from specified modes of investment which were invested out of corpus but withdrawn in 2021 and 21-22 to acquire building. Now that building is going on, building is still there, this will be considered as application of income. That is, purchase of building will be considered as application of income only in the year in which money is redeposited back into corpus funds. Corpus fund means wherever corpus were invested. If you recollect, AY 22-23 amendments were made. The theory part I would like to show you. Application for charitable or religious purposes out of corpus shall not be treated as application of income for charitable purposes. We know pretty well. Incoming corpus not an income, amount spent out of corpus for approved object again not considered application. However, the amount of application or a part thereof which was not treated as application of income as above will be treated as an application in the year in which such amount or part thereof, that is income of subsequent year, is reinvested back or deposited back into specified modes of investment maintained specifically for such corpus. This is what is happening here. This point which was introduced in AY 22-23 is applicable here, but it is applicable only for AY 22-23 and onwards. It will be so considered as an application of income to the extent of such investment or deposit. So what is happening in this question with regards to point number 5? Amount of 15 lakh is deposited into specified modes of investment, that is post office savings account, in the current year. So the moment you deposit in that year, it will be application of income. However, this is applicable only from AY 22-23 and onwards and not for earlier year. AY 22-23 means financial year 21-22. In this smart question asked by institute, 5 lakh is pertaining to 21-22. This will be regarded as application of income in the current year. This will be regarded as application of income. But this amount spent or amount reinvested back which was spent in 2021 out of corpus, 10 lakh rupee, will not be considered as application of income because it must have already been considered as application of income in the year of spending it. It will not be regarded as application of income in the current year now. So only 5 lakh will be considered application of income. 6 point, amount paid to another trust. Now amount can be donated or paid to another trust but not as a corpus. If amount is paid to another trust or contributed to another trust, maybe having same object, similar object or totally different object, that is fine. The condition is that donor trust is donating to donee trust. Donee trust should be registered under section 12AA or 12AB of the Act. Donor and donee both should be registered. Purposes may be different, absolutely totally different, then also it's fine. However, funds donated should not be towards corpus of the donee trust. That is a condition. And secondly, amendments carried out from AY 24-25, major amendment, amount donated if by way of corpus will not be regarded as application of income. But if donated to another trust, not as a corpus, as a regular donation, then it will be considered as application of income only to the tune of 85% of such donated amount. Amount paid to another trust registered under 12AB by way of donation of 10 lakhs. Out of the said amount of 10 lakh, 2 lakh rupees are given as corpus donation. That's it, 2 lakh disqualified. So out of 10 lakh rupees donated, 2 lakh rupees is towards corpus, will not be considered as application of income. Remaining 8 lakh rupee will be considered as application but only to the tune of 85% of such 8 lakh. 85% of 8 lakh would be, I think, 6 lakhs 80,000. Let's calculate it out. 8 lakh into 0.85%. 6 lakhs, yes, 6 lakhs 80,000. I remember the figure. So out of 10 lakh rupee donated to another trust, 6.8 will be considered as application of income. I am writing it down, application. 7th and the last point, big question it is. 6 lakhs being the amount set apart in 22-23. 6 lakhs being amount set apart in previous year 22-23 by the trust for charitable purposes under section 11 subsection 2. Now funds can be, this is what amount set apart means, accumulation, provided assuming AO must have been informed. If AO was informed, then in 22-23 this much fund, 6 lakh rupees, would not have been taxable in that year, provided AO is informed in form number 9A. Form number 9A is furnished 2 months before the due date of filing IT return, and the funds can be accumulated for the approved objects of the trust to be spent within the next 5 years. Are utilized in previous year 23-24. Very good. 5 years is the time limit available. Trust is utilized in the immediately next year. Utilized in 23-24. accumulated in 20 to 23 within 1 year only span. But for making donation to another trust, this is absolutely violation. This is not permissible. One can utilize accumulated funds for the purpose for which funds were accumulated within next 5 years. However, contributing to another trust out of accumulated funds is violation, whose object is also education. Even though same object, that does not matter, that is absolutely irrelevant. This 6 lakhs will be chargeable to tax at a flat rate of 30%. This will be considered as specified income taxable at 30% under section 115 BBI. So 3 places we have put markings. Question comes to an end here. Now we have to answer the objective questions. What is it? 3 places we have put this 30% with this different color. 1, 2 and 1 was here, 3. So 1, 30 lakhs, 2, 10 lakhs and third 6 lakhs. Okay, this much amount will be chargeable to tax at a flat rate of 30%. Now let's understand what are the questions asked. One by one. Question number 7 to 11. Question 7. Seva Niketan wants to avail exemption under section 1023C subclause 3AD and 3AE. This is for education institution, this is for hospital. This exemption under 1023C is possible under subclause 3AD and 3AE provided combined gross receipt for the whole year does not exceed 5 crore rupees. Here, if you recollect, it exceeded 5 crore, it was 6.4 crore or something, 6.5 crore. Here in point number 1, 6.5 crore. Therefore, exemption will not be available. Under 1023C, subclause 3AD, 3AE, exemption not available. Trust can claim exemption under section 11 by spending 85%. Okay. Question 7, can it do so? Answer no. So yes, no, no, no. So yes is a wrong answer. No, 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 it cannot do so since the trust is registered under 12AB. Answer third, no, it cannot do so since aggregate receipts exceeds 5 crore. This is the correct answer. And D is no, it cannot because of reasons mentioned in point number B and C. Correct answer is C because the gross receipt, combined gross receipts for hospital and education institution exceeded 5 crore rupees. Question number 7, answer is C. Let's see whether that is the correct answer or not. Yes, for 7th, C is the correct answer. Okay. Then 8th one. What amount of corpus donation? Corpus was 55 lakh. Received by the trust would not form part of total income. Would not form part of total income means what part of corpus donation will be exempt? Corpus donation will be exempt as per section 12 subsection 1 clause D read with section 11. It is 11(1)D read with section 12. It will not be considered as income provided it is invested in specified modes and it is not utilized for any other purpose other than the purpose for which it was received. So total corpus donation is 55 lakh. Out of 55 lakh, some part was utilized to acquire computers and I remember something was invested in NBFC. Corpus will have to be invested in specified modes of investment by the end of the same year, otherwise it will become taxable. So out of 55 lakhs of corpus donation I have highlighted it here, 55 lakh. Out of that, 30 lakh is utilized to acquire computers. So this 30 lakh will be taxable and that too at 30% rate, that is gone. Remaining is 25. Out of 25, point number 4, 25 lakhs of corpus is invested in 10, 5 and 10. 25 lakh, that way 55 lakh corpus is settled. Out of them, this 10 lakh and this 5 lakh will be eligible, meaning thereby will not be this much, that is 15 lakh will not be taxable, 10 lakh will be taxable at 30% rate. So out of total corpus of 55 lakh, 10 lakh is invested in NBFC and 30 lakh is utilized in acquiring computers. 10 and 30 will be taxable at 30% flat rate under section 115 BBI and that much. So out of 55 lakh, 30 lakh is gone and 10 lakh is invested in NBFC. This is for computer, this is invested in NBFC. This much will become taxable. So question is how much will not be included in total income? That means how much will be exempt? So answer 25 lakhs. No, 15 lakhs will be exempt. 40 is gone. 15 lakh of corpus will be not considered as income. Which 15 lakh? This 15 lakh. Whatever is invested in post office savings account, 10 and whatever is invested in scheduled bank FD. 15 lakh will be eligible for exemption. So question number 8, what is the question? Answer should be 15. C is the answer, 15. 8th is C, 15. Our answer is correct. Okay, next question number 9, something which we were desperately and eagerly waiting for. What would be the amount of specified income taxable under section 115 BBI at the rate of 30% for previous year 23-24? So we have placed marking with a different color pen at 3 places. 3 types of income will be taxable at 30%. One is corpus utilized for acquiring computer, 30 lakhs. That will be taxable, this 30 lakh. Plus corpus invested in NBFC, 10 lakhs, that will also be taxable at 30%. So 30 plus this 10, 40, and plus this 6 lakh rupees amount which was set apart in 20-23 for the purpose of charitable purpose, but it is utilized for donating it to another trust. So this will be violation. This 6 lakhs will also become chargeable to tax. 30 plus 10 plus 6, 46 will be chargeable to tax at 30% rate. 46, yes, 46 is one of the option, B. 9th is B. B is the correct answer. Then 10th. 7th, 8th, 9th, 10th, 11. Okay, what amount would be considered as application of the trust? Application, that is application of 85% of income for the previous year 23-24, excluding unconditional accumulation of 15%. Unconditional accumulation of 15% means initial 15% is exempt. Apart from that, how much extra or how much in addition to that 15% will be considered as application of income. Assuming that trust has fulfilled all the relevant conditions stipulated in section 12A. So which all items will be considered as application of income? We'll have to go backwards, start from the beginning and calculate it out. Okay, so first point, there is no application of income. It talks about receipts 3.10 crore and 3.4 crore totaling to 6.5 crore. Then voluntary contributions included in one is 105 lakh. Out of that corpus is 55 and anonymous donation is 20. Here also there is no application of income. Then third point onwards there is application of income. Third point says computer purchase for 80 lakh. However, out of 80 lakh, entire 80 lakh cannot be called as application of income. Though it is spent for capital asset acquiring, then also it can be application of income, but not to the tune of entire 80. Out of 80, 30 lakh is from corpus. That much will not be considered as application of income. 25 lakh is out of loan. That is also not considered as application of income right now. It will be considered as application of income, this 25 lakh, only in the year in which loan is repaid. Voluntary contribution of 25 lakh, we have placed marking also, this will be application of income. So I am just jotting it down somewhere. 25 lakhs utilized for acquiring computer. Okay, then fourth point talks about corpus donations invested in Post Office Savings Bank, Canara Bank FD and NBFC. This also does not amount to application. So fourth point is gone. Fifth point, deposited 15 lakh towards Post Office Savings account. This is very interesting point and a very smart point of institute. Deposited 15 lakhs towards Post Office Savings account, that is in specified modes of investment, which were utilized for purchase of building. Must have been purchased out of withdrawals from Post Office Savings account. So step number 1, some corpus donation must have been received earlier, which must have been invested in Post Office Savings account or Savings Bank account. Then amounts must have been withdrawn and spent for purchase of building. And now in the current year, out of current year's income, something is reinvested back. How much is reinvested back? 10 and 15, whatever was withdrawn. However, 10 lakh pertains to that year. 10 lakh pertains to, we had jotted down here, 10 lakh pertains to that year when this amendment was not applicable. So 10 lakh must have been considered as application of income in 2021 itself only, the year in which building was acquired. This 5 lakh rupee will be considered as application of income in 21-22. Not in 21-22, which is spent in 21-22, but it is after amendment carried out in AY 22-23. AY 20 financial year 21-22, AY 22-23, this amendment was carried out that anything is spent out of corpus then will not be considered as application of income in the year of spending. It will be considered as application of income in that year in which the withdrawn funds are redeposited back into corpus or redeposited back into specified modes of investment wherever corpus was invested. This is applicable only for those amounts spent out of corpus which were spent on or after AY 22-23. So how much will be considered the application of income? Amount considered the application of income will be only 5 lakhs. 5 lakhs post office savings bank account out of earlier years corpus. Earlier years corpus. It will be regarded as application of income in the current year. Then 6 point. Amount paid to another trust registered under 12 AB 10 lakh. Out of 10 lakh 2 lakh is towards corpus. So 2 lakh will not be considered as application of income at all. 8 lakh can be balanced but only to the tune of 85%, that is 6.8 lakhs. So I am jotting that down also. 6.8 lakh. 85% of 8 lakh to another trust, contributed to another trust. This you seriously need to understand. This is the point where most students faced difficulties. 6 point is done. 7.6 lakhs being the amount set apart in 22-23 is now utilized for making donation to another trust. Okay, this 7 point there will be no impact. Entire 6 lakhs will be taxable at 30% flat rate, and this 6 lakhs donated to another trust out of accumulated funds cannot be considered as application of income. So there is no application of income here. Application of income, only 3 things will amount to application of income: purchase of computer out of current year voluntary contribution and not out of corpus or not out of loan. 5 lakhs amount reinvested back into specified modes of investment which were utilized for acquiring building out of corpus, and 6.8 lakh being 85% of 8 lakh contributed to another trust. 36.8 is the answer. This will be regarded as application of income. Do we have 36.8 as one of the option? Let's check. Yes, 36.8 is the first option only. 10th question answer is A. Let's check whether that is the correct answer or not. 10th A, absolutely. So our answer is correct. 11th one, Seva Niketan claims that anonymous donations received by it during financial year 23-24 are not liable to be taxed under 115 BBC subsection 1 clause 3 at 30% rate. Is the claim of the trust valid? Answer no, absolutely not valid. Corpus donation, even if utilized in acquiring utilized to the tune of 30 lakh rupees in acquiring computer, then also that much will be taxable. If not, determine the tax leviable under section 115 BBC. Okay, anonymous donation. Now here we are talking about anonymous, not about corpus. So anonymous donation was 20 lakh rupees if you recollect the first paragraph. Corpus was 55, anonymous donation is 20. Out of 20, something is not taxable at 30%. How much is not taxable at 30%? We had calculated it out here. This one. Out of anonymous donation of 20 lakhs, something is allowed as a deduction higher of the following two, either 1 lakh rupee flat or 5% of total donation. Total donation including corpus, including anonymous. Total donation is 105, 5% of 105 is 5.25 or 1 lakh rupee, whichever is higher. So 5.25, 20 lakh minus 5.25, 14.75 will be taxable at a flat rate of 30% under section 115 BBC. 30%. What are we being asked? 14.75 or the tax amount? Let's just check it out. 11 question. Determine the tax leviable. Tax leviable would be 14.75 into 30%. 14,75,000 into 0.3. 442,500. 442,500 plus surcharge may be attracted, may not be attracted depending upon how much is the total taxable income. Total taxable income is exceeding 50 lakhs or not, exceeding 1 crore or not, we don't know. Plus health and education cess. Right now health and education cess also we can't add unless and until we know whether surcharge is going to be attracted or not. But 442,500 is the amount. So tax amount would be this much. Is this one of the option? Yes, 442,500. D is the answer for question 11. Question 11 D. Our answer is correct. Then 12 and 13, ABC Bank. Now question number 12 is not on this charitable trust. Case scenario 2 is over. The next is on section 194N TDS. TDS. It says ABC Bank provides the following information relating to cash withdrawals by two of its customers. Now for cash withdrawal 194N TDS is applicable, which is divided into two categories. Some amendments were carried out from AY 24-25 for cooperative society. So those who have not filed IT return for the last 3 years, no ROI filed, then for them the TDS limit is no TDS. There are 3 slabs. No TDS for the first 20 lakhs. If the withdrawal is up to 20 lakhs from one or more than one account, whether savings account or current account, cash withdrawal up to 20 lakh, no TDS. In case withdrawal is more than 20 lakh but up to 1 crore, that is on the next 80 lakh rupees, TDS will be at the rate of 2%. And for cash withdrawal exceeding 1 crore by such people, TDS will be at the rate of 5%. However, second category is others, those who have filed IT returns. For others, what will happen? For others, here straight away 2 slabs, no TDS on cash withdrawal up to 1 crore in the whole year, and in case cash withdrawal exceeds 1 crore, then TDS will be at the rate of 2%. So those who have not filed IT return, for them of last 3 years, then 0, 2 and 5, 3 slabs, 20 lakh to 1 crore and above 1 crore, and those who have filed IT return, for them only 2 slabs, 0% and 2%. Now 2 of the customers of the bank have withdrawn cash withdrawal. ABC Bank is the assessee. We have to decide whether tax will be required to be deducted or not. This is an independent MCQ, has nothing to do with the earlier 2 case scenario. Case scenario 1 had 6 questions, question 1, 2, 3, 4, 5, 6. Case scenario 2 had 4 questions, 7, 8, 9, 10. This is 11th. No, 7, 8, 9, 10, 11, 5 questions. Now this is question number 12. Question 12 is an independent MCQ. Now here amendments were carried out for cooperative society. If cooperative society is withdrawing, then instead of 1 crore, everywhere in both the situation, limit will become 3 crore. Limit will become 3 crore. Okay. So date of cash withdrawal, that's the first column. Second is Arjun. Arjun is withdrawing from savings account. So we'll have to check whether Arjun has filed IT returns for the last 3 years or not. And XYZ Cooperative Society, current account. XYZ Cooperative Society is withdrawing. It may be XYZ Cooperative Society as a bank or may not be bank, that is immaterial. TDS is to be deducted by the bank. Bank is ABC. ABC is the bank. Now person withdrawing is cooperative society, which could be cooperative housing society, cooperative consumer society, cooperative milk producers society, it could be cooperative bank, it could be any cooperative society. Okay. 12th April 2023, 9th May, 15 June, 19 July, 18th October, 5th November, 22nd December and 3rd January. All the dates are of current year. So dates I have underlined, but that is not required. So I am erasing that underlining. Okay. Now how much is a total cash withdrawal? So let's check it out. For Arjun, it is 20 lakh plus 25 lakh, 45, 45 plus 35, 30, 45, 35, 80 lakh plus 25, total is 105 lakhs. He has withdrawn more than 1 crore, so TDS will certainly come. If he has filed IT return of all the last 3 years, then first 1 crore no TDS, balance 5 lakh, TDS will be at the rate of 2%. But if he has not filed IT return for all the last 3 years, then in such situation, first 20 lakh no TDS, 20 lakh to 1 crore, that is next 80 lakhs will be 2% and above 1 crore will be 5%. TDS will definitely be there. Cooperative society, the limit is 3 crore. Limit is 3 crore. Up to first 3 crore rupees of withdrawal, IT return is filed, then first 3 crore, IT return not filed, then first 20 lakh, then 20 lakh to 3 crore, then above 3 crore. Let's check what is the total withdrawal. 68 plus 85 plus 88 plus 57. We'll use calculator for speedy calculation. 68 plus 85 plus 88 plus 57. 298. 2 crore 98. 298 lakhs or 2 crore 98 lakh. Here TDS will definitely not come if IT returns are filed. Let's check whether what is the position. Cooperative society regularly files IT return. So they are regularly filing IT return, then no TDS for first 3 crore. TDS at the rate of 2% will be attracted on that much amount which is withdrawn above 3 crore. So here definitely no TDS under section 194N. Arjun on the other hand has not filed IT return for the last 3 years. All the last 3 years IT return not filed. Then for Arjun what will happen is first 20 lakh during the year no TDS. Next 80 lakhs, that means from 20 lakh and 1 rupee till 1 crore rupee withdrawal, next 80 lakhs TDS will be at the rate of 2%. 25 lakh 2%. Next 80 lakhs TDS will be at the rate of 2%. 25 plus 35 totaling to 60 lakh, again 2%. Still 20 more lakh, furthermore 20 lakh of withdrawal will attract 2%. The next withdrawal is 25 lakh. But out of that, first 20 is gone, no TDS. Next 80 lakh is 2%. Out of next 80 lakh, 25 is gone here, 35 is gone here, 60 lakh. Still next 20 more lakh. So this 25 lakh will have to be split into two parts. First 20 lakh, 2%, and balance 5 lakhs will attract TDS at the rate of 5%. I hope you people have understood this. 2% and 5%. As far as cooperative society is concerned, they have filed IT return for all the last 3 years. Therefore, no TDS at all. No TDS at all. Would cash withdrawals, what is the question? Would cash withdrawals by Mr. Arjun and XYZ cooperative society during previous year 23-24 attract TDS? If yes, how much would be the tax deductible? So for cooperative society, no TDS. So yes, yes, yes. Okay. How much will be the TDS? So for Arjun, first 20 lakh no TDS, next 80 lakh at the rate of 2% will be 1,60,000 TDS amount, and balance 5 lakh out of 1 crore 5 lakh withdrawal, balance 5 lakh at the rate of 5%, 25,000 will be the TD. Total amount will be 1,85,000. Bank will be required to deduct 1,85,000 as TDS. So 185, either of A and B. C 10,000 and 396, C is a wrong answer. 185, D could be correct in respect of cash withdrawal by Arjun, and no taxes required to be deducted on cash withdrawal by cooperative society. D seems to be the correct answer. A says 185 and 396, wrong. B says 185 and 556, wrong. D is the correct answer. Let's check whether this is the correct answer or not. This is question number 12, answer is D. Question 12, D is the answer. Our answer is correct. Now question 13, Blossom Tea Garden, a tea estate in Dibrugarh, Assam. Blossom Tea Garden, we don't know whether it's a company or AOP, whosoever may be, received 23 lakh rupees as compensation from an insurance company for the severe damage to the green leaves due to hailstorm in July 2023 monsoon. Okay, 23 lakh rupees is received as insurance compensation from insurance company. For what purpose is it received? It is received for damage to the tea leaves, green leaves. Blossom Tea Estate is of the view that the entire receipt is under the insurance policy, entire 23 lakh for damage caused by the hailstorm to tea leaves will be agricultural income, hence would not be chargeable to tax. It will entirely be exempt under section 10(1). Now as far as tea people are concerned, those who are in the business of growing and manufacturing of tea, for them rule 8 is applicable. Rule 8 is applicable whereby 60% will be considered as agricultural income and 40% will be considered as a non-agricultural income or business income. However, this 60-40 rule is to be applied only if company or the assessee, whosoever may be the assessee can be individual HUF anybody. 60-40 rule is applicable only in case where assessee is into composite business. Composite business means combined business of growing and manufacturing both of tea. If there is only growing of tea, then entire income, 100% income will be agricultural income and will be eligible for exemption under section 10(1). If it is only manufacturing business, then entire income will be business income, entirely will be chargeable to tax, nothing will be exempt. If and only if company or the assessee is engaged into both the businesses combined together, which is called composite business, then only we apply 60-40 percentage. So what is the question? So they have received 23 lakh rupees for the loss of green leaves. And assessee is of the opinion entire 23 lakh should be agricultural income, chargeable to tax, but as an agricultural income, therefore it will be indirectly exempt. Otherwise, they are ready to offer it to tax, but as agricultural income. examine the contention of Blossom Tea Garden. In my opinion, Blossom Tea Garden, whatever they are stating is absolutely correct. What are the 4 options? Blossom Tea Garden's contention is incorrect and entire compensation is accessible as income from other sources, IFOS. Second option, B, Blossom Tea Garden's contention is incorrect, entire compensation is accessible as PGBP manufacturing income. This is definitely a wrong contention. This is definitely a wrong option. Blossom Tea Garden's contention is incorrect because it is deemed to be profit on sale of standing crop or the produce, therefore the same is taxable as PGBP income. So option ABC, all 3 are saying assessee's contention is incorrect. First option says it is taxable as IFOS, income from other sources. Second option says it is taxable as manufacturing income, and third one says it is taxable as PGBP income. All 3 options are incorrect in my opinion. Let's see what is the answer. Let's check what is the fourth option. Fourth option says Blossom Tea Garden's contention is absolutely correct. This seems to be the correct answer. Why? Because it is for the damage or the loss of tea leaves or green leaves. Green leaves, that means it is entirely agricultural income. There is no manufacturing element involved in the matter. Therefore, it cannot be composite income. No need to split it into 60-40 ratio, applying rule 8. No part of the income or no part of the compensation consists of manufacturing income, and it cannot be apportioned as per rule 8 between manufacturing income and agricultural income. Therefore, entire income will be agricultural income. In my opinion, D is the correct answer. Let's check what is the answer. For 13, D is the answer. Absolutely correct. Now the next should be 14, but I am skipping 14, 15 right now. I am jumping to question 16. Question 16 is small one. It is on revision. Small one. That's why we can finish it off in 5 minutes. Come to question 16. It is on revision. Do you remember that chapter, appeals and revision? Revision possible under 2 different sections, section 263 and section 264. Revision can be done by principal CCIT, CCIT, CIT and PCIT. Okay. So what is the question? Question is, Commissioner of Income Tax issued notice to revise the order passed by an AO. That's what he can do under section 143. Order is passed by AO under section 143, probably assessment order under 143.3. During the pendency of proceedings before Commissioner, on the basis of material gathered during survey under section 133A, after the issue of first notice, so Commissioner must have issued a notice under section 263, a show cause notice. Please show us a cause why order passed by AO should not be revised for so and so reason. And now after issuing the first notice under section 263, there is a survey under section 133A. During survey, some extra material comes to notice of CIT. Commissioner now intends to pick up the case again. Commissioner of Income Tax issued a second notice, the contents of which were different from the contents of the first notice. Well, this question seems little incomplete, assuming that it is for the same assessment year for which the first notice was issued. For the same year, second notice is also issued, but after considering some extra material gathered as a result of survey under section 133A. Examine whether the action of Commissioner is justified as to the second notice or not. Similar question was asked a number of years back, which we had discussed during the classroom session. Now here, section 263, 264, both of them, if you recollect, the concerned CIT, PCIT, CCIT, PCCIT can call for and examine the records, if you recollect the language used here. Section 263 and 264. So 263, CIT or so and so, they can call for and examine the records of any proceeding in which there is an order passed by AO. And such order is erroneously, and due to error, erroneously it is prejudicial to the interest of revenue. Now what do you mean by record? That has not been clarified, so I had highlighted that word, and there was a Supreme Court decision, CIT versus Shri Manjunatheshwara Packing and Camphor Works. Supreme Court stated that the word record would mean everything and anything which is available on record at the time of examination of the file by the CIT, PCIT, CCIT, PCCIT. So opportunity of being heard will have to be given by CIT, PCCIT, etc. by issuing show cause notice. Please show us a cause why your case should not be subjected to revision. Okay, then Seventh point, there was record, the meaning of the term record. CIT versus Manjunatheshwara Packing and Camphor Works. Supreme Court in 1998 stated that record would mean not only those things which were available on record at the time of passing of order by AO, but will also mean everything and anything which is available at the time of examination of file. Now, if you recollect appeals chapter, in appeals chapter we had made a comparative analysis between the powers of CIT appeal, JCIT appeal on one hand and ITAT on the other hand. There was a list of 15 powers in a tabular form I had covered. One of the point was whether there is a power to consider additional evidence or not. Additional evidence, additional material can be taken into account or not. The answer is strictly no. Additional material cannot be considered by CIT appeal, JCIT appeal or ITAT, nor can assessee produce them on record. Any evidence or any material which assessee did not produce at the earlier level cannot produce now at the time of appeal before CIT appeal, JCIT appeal or ITAT. Time pass activity not entertained. Assessee produced one evidence at the time of AO, now produces another evidence which can change the situation. That is not permissible. Extra materials cannot be taken into account, subject to exception. Only in exceptional cases they can be taken into account. Similarly, at CIT or PCIT or CCIT, PCCIT level under section 263, when we are talking about a term record, the position is this way. At the time when AO passes the order, there are 6 materials available. 6 materials available on record. But after that, there is one more material that becomes available on record. When CIT calls for the file, when CIT examines the file, at that time there are total 7 materials available. 6 at the time of passing the order by AO, one more material at a later stage, totaling to 7 material. All the 7 materials can be taken into account by CIT. However, question is not on these 7 materials. Question is on one more material available as a result of survey. One more material available, making the total 8 materials. Now, whether this 8th material can be taken into account or not, that is a question. This material has come up into picture as a result of survey proceeding under section 133A. Whether this can be taken into account or not, the answer is clearly no. Actually, why this material is allowed to be taken into account? Because this material is not an extra material. This material, 7th material, is already available on record at the time of examination of file by CIT. Anything now available will be called as extra material, and extra material or additional material really cannot be taken into account. 7th material is not an extra material because it is already placed on records at the time of examination of file by CIT, but this 8th material cannot be taken into account because this is an additional material. So question is based on that. So action of commissioner is justified or not with regards to second notice. Second notice is issued after considering extra material which was made available as a result of survey under section 133A. So what is the answer? Answer is CIT's contention with regards to second notice is not correct. Second notice is not tenable at law because that takes into consideration or that is based on additional material. How institute has answered this question? 16th one. The action of commissioner in issuing second notice is not justified. So first you answer in a plain language. First you clarify the answer. Then the paper corrector who is interested in reading further, he will read further, he will see your justification. So institute has given a very big answer, but that much is not required. Simply additional material will be that material which is placed on the record after the examination of file by CIT. Anything which is available on record at the time of examination cannot be called as extra material. Therefore, that can be taken into account as per Supreme Court decision. Any material which is now available on record after the examination of file by CIT, that will be considered as an extra material. The term record has been defined in clause B of explanation to section 263(1), and we have a Supreme Court decision also, and it is defined in the Act also. According to this definition, record shall include and shall be deemed to have always included all records relating to any proceeding under the Act available at the time of examination by Commissioner. At the time of examination. In our example, 7 materials were available. In other words, information, material, report, etc. which were not in existence at the time of assessment was made At the time of AO, there were 6 materials at the time of making assessment. And it came into existence later on, 7th material we are talking about, can be taken into consideration by Commissioner for the purpose of section 263 only if that material was available at the time of examination of file. However, at the same time, in view of the express provisions contained in clause B to explanation 1 to section 263, such information, material, report, etc. can be relied upon by Commissioner only if the same forms part of record when the action under 263 is taken by Commissioner. Action under section 263 is taken by Commissioner means at the time of examination. Issuance of notice under 263 succeeds the examination of the record by Commissioner. So notice under 263, show cause notice is issued after examination is over. In the present case, Commissioner initially issued first notice after examination of the record. So examination is completed, notice, that is first notice is already issued. Now the third stage, survey takes place. Subsequent second notice was on the basis of further material under 133A, which is additional material, which was totally unrelated and irrelevant to the issues sought to be revised in the first notice. Accordingly, material on the basis of which second notice was issued could not be said to be record. Eighth material cannot be considered as a part of the record. It is an absolutely additional material available at the time of examination as emphasized upon in explanation 1 to clause B to section 263(1). With that, 16th one is over. Simply in 16(1), mainly when you are attempting this question or this kind of question, mainly answer this way. This particular sentence your answer should start with. Later on, what are the internal contents? Some paper correctors don't bother to read also. 90% of them, they will give you marks based on the quantity of the answer. Avoid cancellation, answer this much. Not very briefly, but concisely answer it this way. Okay, now coming to question number 17. Now question 13, we are done till 1 till 13. Question 14, 15 we have kept pending. I am jumping to question number 17. Question 17 is on assessment procedure. It is on section 147, reopening of the case. Institute has given story of two people, two friends. In one person's case, there is a search conducted and accordingly case is to be reopened. Let's try to understand whether notice under section 148 is valid or not. That is the question. In respect of Mr. Naksh, first paragraph running into 3 lines talks about Naksh, who is engaged in the export of fabrics. Information is flagged as per the risk management strategy, that is RMS, formulated by CBDT for AY 2021, 21-22, 22-23 and 23-24. For 4 assessment years, information is flagged about Naksh. Story of Naksh is over. What information is flagged that we are not concerned with? It is the information about income escaping assessment, naturally. Second paragraph talks about Mr. Ramesh. Ramesh is a friend of Naksh who is engaged in trading of commodities. Naksh was engaged in fabric export and this guy is engaged in trading of commodities. Search was initiated. Search was initiated under section 132 in April 2024, consequent to which AO has in his possession certain documents showing information pertaining to shares of the value 28 lakhs purchased in previous year 17-18 and shares of the value 21 lakhs purchased in previous year 18-19. Previous year 17-18 and previous year 18-19, that is AY 18-19 and 19-20. 28 lakh rupees worth of shares and 21 lakh worth of shares totaling to 49 lakhs, which is less than 50 lakhs. Less than 50 lakhs. Okay, this is the story of Mr. Ramesh, but search has been conducted in his premises. Under section 132, the story is little different. For Naksh, information was flagged in the system, RMS system of CBDT, whereas in case of Ramesh, search has been conducted. Can the assessing officer issue notice under section 148 to Mr. Naksh and Mr. Ramesh in April 2024? We will see. If so, in respect of which assessment year can the notice be issued? Is it necessary that they be provided with an opportunity of being heard before issuance of notice? So 2 questions are asked, whether case can be, or rather 3 questions, whether case can be reopened by issuing notice under section 148 or not. If yes, then for which of the assessment years, and third, whether opportunity of being heard will have to be given or not. So if you recollect, assessment procedure chapter, reopening of the case is entirely governed by combination or a package of 7 sections. Section 147 is a main text, 148 is a notice to reopen, but before issuing the notice, section 148A says that AO will have to do two things. Will have to conduct inquiry and pass an order stating that this is a fit case for reopening, fit case for issuing notice. Time limit for issuing notice is given in section 150 and other sections are exceptions and approval of higher authority, miscellaneous, etc. Most important is time limit and section 148A inquiry before assessment. So 147 simply says that whenever it comes to knowledge of AO that income chargeable to tax has escaped assessment, AO can reopen for any assessment year by issuing notice under section 148. Now 148 proviso to section 148 notice states that AO can issue notice, or rather no notice can be issued unless two conditions are fulfilled. Number A, AO has information which suggests that income chargeable to tax has escaped assessment for the relevant assessment year. This is the most important condition. And he has obtained approval of higher authority. That is okay, but most important is AO should have information which suggests that income chargeable to tax has escaped assessment. Now, there are certain provisions in the Act which say that in following four cases, AO will be deemed to be having information which suggests that income has escaped assessment. So, explanation 1 to section 148 clarifies the meaning of information with AO which suggests that income has escaped assessment. Any information which is in the case of assessee in accordance with the risk management strategy. So, in case of Naksh, this point will be applicable given in explanation 1 to section 148. Or there is any audit objection or information under section 1990A, DTAA, information as per section 135A, or information based on order of any tribunal or any court. However, so Naksh, as far as Naksh is concerned, the first person, his case will fit here. In his case, there is definitely information because information is generated through risk management strategy, RMS software of CBDT. Explanation 2 to section 148 says that in following circumstances, whenever search is conducted or survey is conducted, in four cases, AO will be deemed to be having information which suggests that income chargeable to tax has escaped assessment. Meaning thereby, in case of Naksh, this point will be applicable. Explanation 1 to section 148. For Naksh, there is information which suggests that income chargeable to tax has escaped assessment. As far as Ramesh is concerned, his case will fall under explanation 2. Search is conducted in his premises, or there is a survey, or there is a search in the third person's case and assessee's assets are found, or search is fourth point, search is conducted in the case of third party and assessee's books of accounts documents are found. Any which ways, Ramesh's case will fall under first category. In his own case, search has been conducted. In these two situations, there is definitely information that income chargeable to tax has escaped assessment. That means AO can reopen. However, in order to reopen the case, AO will have to conduct inquiry under section 148A, will have to issue notice under section 148 within the time limit given in section 149. Time limit given in section 149 is 3 years from the end of the relevant assessment year. But instead of 3 years, time limit will be 10 years from the end of the relevant assessment year in case if income escaping assessment, income which is chargeable to tax and has escaped assessment is represented in the form of some asset or expenditure or entries in the books of accounts valuing to 50 lakhs or more than 50 lakhs for all such relevant assessment years combined together. Okay, so in 4 cases AO shall be deemed to be having information. Now 148A, conducting inquiry. So question part 1, can AO issue notice? That is the first question. Answer yes. Yes, it is a fit case, but AO will have to conduct inquiry. However, according to section 148A, inquiry will have to be conducted by issuing show cause notice to the assessee, giving opportunity of being heard by issuing show cause notice. Assessee's reply will have to be considered. Consider the reply of assessee, and finally by passing the order, AO will have to decide whether it is a fit case for issuing notice under 148 or not by passing an order in writing. However, proviso to section 148A says that in following cases 148A will not apply, meaning thereby no need to give opportunity of being heard to the assessee. Straight away notice under section 148 can be issued. 148A can be skipped. So first we discussed section 147 and 148. 148 explanation 1 for Naksh, information available with AO. Explanation 2, in case of Ramesh, search is conducted, therefore information which suggests that income chargeable to tax has escaped assessment, that information is available with AO. Case can be reopened. That's a part 1. Now part 2 of the question, Is it, or rather part 3, third question is it necessary that they be provided with an opportunity of being heard? So opportunity is required under section 148A, but opportunity is not required if there is a search conducted. In case of Ramesh, opportunity need not be given. Or search is conducted in third party's case, assessees money, bullion, jewelry or valuable assets found. Search conducted in third party's case, assessees books of account documents are found. And fourth situation, which was introduced with effect from AY 20 to 23, AO has received information under section 135A. So as far as Naksh is concerned, opportunity of being heard will have to be given. As far as Ramesh is concerned, his case fits here, search is conducted, therefore no need to give opportunity of being heard to him. And second part of the question is asking, for which of the years, for which assessment year notice can be issued? So answer, ideally notice can be issued for 3 years. Unless the income escaping assessment is based on or represented by assets or entries in the books of accounts or expenditure which is amounting to 50 lakhs or more. I'll show you that point. So notice under section 148 has to be issued within the time limit given in 149. Time limit given in section 149 is this way, 3 years from the end of the relevant assessment year, but instead of 3 years, beyond 3 years, but up to 10 years from the end of the relevant assessment year if income chargeable to tax is represented in the form of asset. So as far as Ramesh is concerned, his income escaping assessment is represented in the form of shares. So as far as Naksh is concerned, time limit would be 3 years. This will be for Naksh. As far as Ramesh is concerned, for him also time limit will be 3 years and not 10 years. Why? Because the income escaping assessment represented in the form of asset, expenditure or entry should be amounting to or likely to amount to 50 lakhs or more. In case of Ramesh, what is happening is the amount is 28 lakhs and 21 lakhs totaling to 49 lakhs, which is less than 50. Therefore, time limit will be 3 years for Ramesh also. So for which of the assessment year notice can be issued? Answer, notice can be issued for Naksh. Information is received for 4 assessment years. AY 2021, 21-22, 22-23, 23-24. Time limit will be 3 years from the end of the relevant assessment year. Notice can be issued for AY 23-24, can be issued for AY 22-23. For AY 22-23, notice can be issued up to 31st March 26. AY 21-22 also notice can be issued up to 31st March 2025. But for AY 2021, notice could have been issued up to 31st March 2024. And here AO is issuing notice in April 2024. Therefore, notice cannot be issued for AY 2021, can be issued for 21-22 AY, 22-23 and 23-24. Same will be applicable in case of Ramesh also. However, as far as Ramesh is concerned, he does not have AY 21-22, 22-23 or 23-24 involved in the case. In his case, previous year 17-18 and previous year 18-19, these 2 years are involved, which are beyond 3 years from the end of the relevant assessment year. So as of April 24, notice cannot be issued in case of Ramesh, but notice can be issued for Naksh. But for Naksh, notice can be issued only for 3 of the assessment years out of total 4 assessment years given. Okay. Now, second part of the question is asking you what would be your answer with respect to issue of notice to Ramesh, the one in whose case search was conducted, if the shares purchased in 17-18 were 30 lakhs instead of 28 lakhs and all other facts remain the same. If shares were worth 30 lakhs, earlier it was 28 lakhs plus 21 lakhs totaling to 49 lakhs. Therefore, notice could not have been issued for 17-18 and 18-19 previous year. Now the amount is 30 lakhs plus 21 lakhs. The total amount is 51 lakhs. Since it is 51 lakhs, notice can be issued up to 10 years. Which 10 years? So notice can be issued for 23-24, 22-23 assessment year I am talking about, 21-22, 20-21, 19-20, 18-19, 17-18, 16-17, 15-16 and 14-15. Notice cannot be issued beyond that. Here the previous year involved for Ramesh is 17-18 and 18-19. Previous year 17-18 and 18-19 are these 2 years. The total amount of income escaping assessment represented in the form of shares, that is asset, is amounting to 51 lakh. Notice can be issued for these 2 years. Earlier in the first part of the question, notice could not have been issued because it fell beyond 3 years time limit. Time limit for Ramesh was 3 years. For Naksh it is definitely 3 years. For Ramesh earlier it was 3 years when the total amount of shares was 49 lakh and now it will be 10 years and accordingly notice can be issued for these 2 years. amount of income escaping assessment represented by shares need not exceed 50 lakhs for each and every year involved in the matter. It should exceed 50 lakh rupees in totality. So now notice can be issued. Yes. Earlier answer was yes. For Naksh, Ramesh, no. For Naksh, opportunity of being heard will have to be given by issuing notice under section 148. Now let's check out the answer if you have understood. 17 question in respect of Naksh. In respect of Naksh, assessing officer has information suggesting that income is escape assessment for section 148A since information has been flagged for the relevant year as per risk management policy formulated by CBDT. That we already discussed. Even for Ramesh also, because search is conducted. Notice can be issued for AY 23-24, 22-23 and 21-22 only for 3 years since 3-year time limit from the end of relevant assessment year has not expired as on April 2024, the month in which AO intends to issue notice. Such notice can be issued after conducting inquiry. Inquiry will have to be conducted under section 148A. For Ramesh, search is conducted, inquiry need not be made. In the sense, 148A will not apply if required with respect to information suggesting income escaping assessment and providing an opportunity of being heard to Naksh by serving show cause notice. Thereafter, on the basis of material available on record, including reply of Naksh in response to show cause notice, AO has to decide whether or not it is a fit case to issue notice under section 148 or not by passing an order with the prior approval of higher authority. Notice cannot be issued for AY 2021 because it falls beyond 3 years from the end of the relevant assessment year. In case of Ramesh, this was a story of Naksh. Now as far as Ramesh is concerned, what is the part? Search has been conducted under section 132 in April 24. Therefore, time limit does not become 10 years just because search is conducted. 10-year time limit will be available only if income escaping assessment is represented in the form of asset, expenditure or entries in the books of account which is amounting to 50 lakhs or more. So it is amounting to 49 lakh rupees. Amount is less than 50, therefore notice cannot be issued beyond 3 years. Time limit would be 3 years. Accordingly, for AY 18-19 and 19-20, which is relevant to previous year 17-18 and 18-19, 3-year time limit has already expired on 31st March 22 and 31st March 23 respectively. Therefore, notice cannot be issued on under section 148 in April 24. However, second part, if the total amount is 51 lakh 30 plus 21, then notice can be issued with the prior approval, which has not a time limit of 10 years, has not yet expired in April 24. In this case, AO need not conduct an inquiry. For Ramesh, inquiry need not be conducted because his case is governed by explanation 2 to section 148, which says no need to conduct inquiry, straight away 148A will be applied. Okay. Now notice there is one extra point which we had discussed in the class, that all these new provisions were introduced in section 147 with effect from 1st April 21. So if the search is conducted on or after 1st April 21, but if the case of any earlier year is to be reopened prior to 1st April 21, then earlier time limit will also have to be applied. Earlier time limit under section 147, 148, 149 was 6 years from the end of the relevant assessment year. It was 4 years and 6 years. So whether the 6-year time limit is expired or not, this entire paragraph if you don't write, it's okay. That has also not yet expired in April 2024. So for AY 18-19 and AY 19-20, if you apply 6 years time limit, old time limit, then that is yet to expire on 31st March 25 and 31st March 26. So earlier time limit has also not expired, whatever was the time limit applicable before introduction of new version of section 147. Therefore, notice can be issued. Okay. With that, question number 17 comes to an end. Now the next is question number 18. Question number 18 is on Black Money Act, BMA 2015. Black Money Act was introduced to curb what you know pretty well, undisclosed foreign income and undisclosed foreign assets. Tax rate is 30%. BMA 2015 applies to the whole of India, including Jammu Kashmir. According to Black Money Act 2015, undisclosed foreign asset and undisclosed foreign income will be charged to tax at a flat rate of 30% plus 300% penalty. So if you recollect, it was introduced from 1st July 2015, announced on 26 May 2015. Financial year 15-16 or AY 16-17 it was introduced. Two things would be taxable under this act: undisclosed foreign income from source outside India, or undisclosed asset located outside India. As far as asset is concerned, we have to see the location. As far as income is concerned, we have to see the source. Tax rate is flat 30%, no surcharge, no health and education cess, penalty will be 300%. AO will have to issue notice. As far as income is concerned, the amount of income will be chargeable to tax at 30% rate, and as far as foreign asset is concerned, the value of the asset will be chargeable to tax, value to be computed as per valuation rules. Now what is undisclosed income, what is undisclosed asset, that is clarified. It applies to whole of India effective from financial year 15-16, AY 16-17. However, rate of tax is 30% plus penalty 300%. However, it is applicable only to assessee. What do you mean by assessee? Assessee means a person who is resident in India. Anybody, individual, HUF, AOP, BOI company, but should be resident. Resident in which year? So either should be resident in the current year, the year in which notice has been issued by AO, or the year in which the undisclosed asset comes to the notice of AO. Or he should be resident in the current year, or he should be resident in that earlier year. If current year is non-resident or RNR in the current year, but was resident in India in that earlier previous year, that previous year in which income relates, that previous year to which income relates, or that previous year in which undisclosed asset was acquired. So undisclosed asset was acquired in financial year 17-18, and today financial year 23-24. Assessee should be resident in India either in 17-18 or in 23-24 or both of them. If he is non-resident in both the years, then Black Money Act is not applicable. So what is the question? Mr. Rohit, an Indian citizen, returned to India in March 2013, that is financial year 2012-13 ending, to assume the role of CEO at ABC Private Limited, an Indian company. That's okay. He served in this capacity from 1st April 13 to March 2020. April 13, that is financial year 13-14 till March 2020, that is financial year 19-20. 13-14, 14-15, 15-16, 16-17, 17-18, 18-19, 19-20. He was in India for 7 long years. 7 years he worked as a CEO of ABC Private Limited. Prior to this, that means prior to financial year 13-14, from May 2000 till February 2013, for 13 years he was working with Red Incorporation USA. So those 13 years he was non-resident, these 7 years he is resident. His residential status will play a very important role in order to decide whether Black Money Act is applicable to him or not. I repeat, Black Money Act is applicable to such an assessee who was resident in that earlier year or who is resident in the current year, either of them. So 7 years when he was in India, he was resident. Prior to that, 13 years he was in USA, he was non-resident. In April 2020, that is after completing his tenure in India, 7 years, he went back to USA to rejoin Red Incorporation. So those 7 years when he is present in India, he is a resident. Prior to that, 13 years he was in USA, he was non-resident. After 7 years, again he becomes non-resident, he goes back to USA and permanently settled there. Rohit visits India every year only for 1 month. 1 month when he was staying in USA. So after 2020, April 2020, he visits India for 1 month. So ideally he would be non-resident for all future years. It was found that when he was CEO of ABC Private Limited, that means during those 7 years, he accumulated undisclosed income and wealth as below. Number 1, he acquired when he was present in India, when he was resident in India. He acquired shares of listed companies in USA. This is foreign asset and it is undisclosed, very clearly given. Foreign asset undisclosed, acquired on 10th December 2012. 10th December 2012, that means financial year 12-13. Then acquired 1 apartment in London on 20th April 2015. 20th April 2015 means financial year 15-16. Apartment, that is immovable property. That time also he was resident in India. That time he was resident. 12-13 he was non-resident. He came to India in 13-14. He came to India in March 13, 12-13 but ending. So that means he would be non-resident for 12-13. 13-14 financial year onwards, he is present in India for 7 consecutive years. So 12-13 he was non-resident. 15-16 he is resident. Then Third, he established a leather goods manufacturing factory in Malaysia, that is outside India, foreign asset, on 15 April 2020. 15 April 2020, that means financial year 2021. 2021, was he resident or he was non-resident? Answer is non-resident, because he comes to India only for 1 month. He was present only till 31st March 2020. He was present in India only till financial year 1920. Financial year 2021, he was certainly non-resident. He is back to USA. So these three assets shares one apartment and one factory in Malaysia. He also earned income by taking commission from various foreign buyers located outside India during the period between April 13 to March 20, when he was CEO of ABC Private Limited, during those 7 years. So during those 7 years he was a resident? Answer yes. During those 7 years, the year in which he acquired or he earned income, that time he was a resident. The above undisclosed assets came to the notice of AO in April 2023. April 2023 means financial year 23-24, and he issued notice under Black Money Act in July 2023. When did AO issue notice? That is irrelevant. Again, notice is issued in the same financial year, but if notice was issued in a different financial year, then that does not matter. We are not concerned with the financial year in which the notice is issued. We are concerned with the financial year in which the foreign income, undisclosed foreign income and undisclosed foreign asset comes to the notice of AO. That is happening in April 23, which is financial year 23-24. 23-24, he is non-resident. He was resident in India till financial year 1920. 2021, 21-22, 22-23, 23-24. This is the fourth year of his being non-resident. He comes to India only for 1 month. Is the notice issued by AO under Black Money Act to Rohit tenable in law? So answer, in order to issue notice, now we are not here to calculate the tax 30% because valuation is not given. We don't have the value of any of the foreign asset. We don't even know the amount of commission income earned in financial year 13-14 till financial year 19-20. So tax is not to be computed, penalty not to be computed, interest not to be computed, nothing is to be done. What we are supposed to comment upon is whether notice issued is tenable in law or not. So in order to issue notice, assessee should be resident in either of the years. Assessee should be resident either in the current previous year, the year in which asset or income comes to notice of AO, that is April 23, or he should be resident in that previous year in which undisclosed asset was acquired or undisclosed income was earned. So as far as asset is concerned, there are 3 levels given, and as far as income is concerned, so asset shares were acquired in 12-13, apartment was acquired in 15-16, and factory was acquired in 20-21. 12-13, 15-16, 20-21. 12-13, 15-16, 20-21. What is the position? So he came to India in 13-14, he was there till financial year 19-20. We are talking only in terms of financial year. Assessment year concept is not applicable here. Okay. So in 12-13 he was non-resident. Right now in the present year, current year is definitely non-resident. 12-13 he was non-resident, 15-16 he was resident, and 20-21 again he is non-resident. In order to issue notice, he should be resident in either of the years. He is resident only in financial year 15-16. That means notice can be issued only with regards to that one apartment at London. Notice cannot be issued for 12-13 when he acquired shares, because he is non-resident in both the years. The year in which asset comes to notice of AO as well as the year in which undisclosed asset was acquired. If both the time he is non-resident, then he cannot be subjected to Black Money Act. Similarly, for factory in Malaysia, he is non-resident in the current year as well as non-resident in the year of acquiring factory. Notice cannot be issued. However, as far as income is concerned, income was earned between financial year 13-14 till financial year 19-20. Financial year 13-14 till 19-20 with regards to income, commission income. First 3 were with regards to asset, now it's with regards to commission income. As far as income is concerned, he should be resident either in the current year, whereby he is non-resident, or he should have been resident in the year of earning such income. So he was resident in all the 7 years, therefore technically notice can be issued. However, Black Money Act was introduced with effect from financial year 15-16. So as far as income, undisclosed income is concerned, notice cannot be issued for any previous year or any financial year prior to financial year 15-16. So as far as this 13-14 to 19-20 is concerned, income is concerned, I would like to expand it further. So I would like to show you this way. 13-14, 14-15, 15-16, income earned in 16-17, 17-18, 18-19 and 19-20, 7 years. All these 7 years in a current year, for all the 7 years, current year he is non-resident. Current year is non-resident, 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 non-resident. But he is resident in India in all the 7 years. So the year in which income was earned, he is a resident. However, notice cannot be issued for any previous year prior to 15-16. Therefore, notice cannot be issued for these 2 years. At that time, Black Money Act was not there. This rule is applicable only with regards to income, not with regards to asset. So asset which was acquired in 12-13, for that the notice cannot be issued otherwise also, because he was non-resident in both the years. And 15-16 and 2020-21 for asset we have 3 points: shares, 1 apartment and 1 factory in Malaysia. So notice can be issued with regards to undisclosed foreign income for 1, 2, 3, 4, 5 of the years. And as far as asset is concerned, notice can be issued only for financial year 15-16. Let's check what is the answer. Validity of the notice issued under Black Money Act. Every assessee would be liable to tax at 30% rate. That we know. Section 2 defines assessee to include person who is resident in India in the current previous year, or who's currently non-resident or not ordinarily resident in the current year, but who was resident in India either in the previous year in which income was earned or income relates to, or resident in that previous year in which undisclosed asset was acquired. Accordingly, notice can be issued for financial year 15-16 for asset, and 5 of the previous years or 5 of the financial years for income. Rohit is non-resident in the current year. So current year is out of question. That is previous year in which notice is issued by you. This is a wrong sentence. Bracketed wordings are wrong. He should be resident not in the year in which notice is issued by you. He should be resident in the year in which undisclosed asset or income comes to notice of you. Since he returned to USA in April 2020, financial year 2021, and visited India for only 1 month every year. He was also non-resident for 12-13 when he acquired the shares. So as far as shares is concerned, this is the first point. He is non-resident in both the years, notice cannot be issued. But in 2021, when he established leather goods manufacturing factory, again he was non-resident. So this is the third point, third asset. So for first asset and the third asset, shares and for factory, he is non-resident in both the years. Therefore, when he acquired apartment, however, he was resident in India in previous year 15-16 when he acquired apartment in London. Therefore, notice under section 10 is tenable in law in respect of apartment in London for financial year 15-16 because he was resident in that previous year. However, notice in respect of shares acquired in 12-13 and leather goods manufacturing factory in 2021 is not tenable because he was non-resident in both these years. As regards commission income earned from foreign buyers from 15-16 to 19-20, notice can be issued. Notice cannot be issued prior to 15-16 because does not fall within the scope of Black Money Act. Black Money Act was introduced from financial year 15-16, AY 16-17. That's it. With that, question number 18 comes to an end. Now the next question is question number 19. 19 question, friends, is on DTAA, Double Taxation Avoidance Agreement, but a classic question. Heads off to Institute for asking such a beautiful question. This is the question involving foreign currency conversion also. That means rule 115 will be also applicable. Plus, whenever there is a question on DTAA in case of individual, their question arises is whether he is opting for normal tax provisions, that is old tax regime, optional tax regime, or he is opting for default tax regime under section 115 BAC. So at some places you will have to apply the provisions of section 115 BAC subsection 1A also, which is totally being revamped with effect from AY 24-25. Mahesh, age 50 years, non-senior citizen, is a CEO of Silver India Limited since 1st April 2019. His income in India consists of, so you'll have Indian income as well as foreign income. 3 incomes are given which are Indian income: salary before standard deduction, is 23 lakh. Of course, even under 115 BSc also, he will be eligible for 50,000 rupees up to 50,000 rupees of standard deduction. Interest in respect of self-occupied property. Interest in respect of self-occupied property, that means interest must have been paid. So his income in India consists of, that is a wrong title given by institute, because second point is not an income. First is income, salary. Third is also income, interest on bank fixed deposit 1,60,000 taxable under IFOS. But the second one, interest in respect of self-occupied property, is outgoing. It is not an income, it is expense. However, it is with regards to SOP property. If he opts for 115 BSc, then 1,80,000 will not be allowed as a deduction. In case he opts for normal provisions, that is optional tax regime, then he will get this deduction up to 2 lakh rupees. Now let's check whether in 115 BSc this is allowable or not. As far as 115 BSc subsection 1A is concerned, which is newly introduced from AY 24-25, the provisions are totally being revamped. Earlier 115 BSc subsection 1A is deleted with effect from AY 24-25. Under 115 BSc subsection 1A, if for salary head, deduction under section 16 are not allowed. Tax rates will be applicable, lower tax rate, but if assessee ready to compromise with certain tax benefits. Standard deduction was not allowable earlier, but now it is allowable under section 16 clause 1A. Standard deduction was not allowed as per subsection 1, but now it is allowable. And as far as house property head is concerned, under the house property, what all things are not allowed? Two things not allowed. Deduction under section 24 clause B. Interest on housing loan for SOP, only for SOP. LOP and DLOP it is allowed, only for SOP not allowed. So this particular thing will not be allowed as a deduction under 115 BAC subsection 1A. So we don't know whether he is going to opt for 115 BAC or not. We'll see. And interest on bank FD is taxable under the income from other sources. Deduction under 80 TTB is not available with regards to interest on bank FD to non-senior citizen. It is available only to senior citizen. Therefore 80 TTB is out of question. Again, 80 TTA not allowable, that is only for savings account interest. He has following income for the year ended 31st March 24 from country A. Number 1, income from business in country A, US dollar 25,000. Now here we will have to apply rule 115 and convert from foreign currency into Indian currency, from US dollar to Indian currency, by applying telegraphic transfer buying rate of State Bank of India, TTBR of State Bank of India as on particular date. What rate to be applied, will keep it pending. First income from country A is business income. Second income is rent from house property in country A, US dollar 4,500. This is again IFHP income. Here 30% standard deduction will be allowable. When this income is merged with Indian income, at that time 30% standard deduction will be allowed. But before that, we have municipal taxes in connection with the same property in respect of the above house, not allowed as a deduction in country A, 450 US dollar. But in India it is allowed as a deduction. In India it is allowable. Foreign country, country A, it is not allowable. So in India it will become 4,500 minus 450. It will be 4050 minus 30% standard deduction, 30% of 4050. Balance will be the IFHP. These two are combined point. Next income, third income is dividend from shares held in country A, where dividend was declared and paid in March 24, US dollar 10,000. This is again IFOS. This is the third income from country A, and the fourth and the last income is short-term capital gain. Short-term capital gain of US dollar 5,000. On sale of shares of companies registered in country A, and sale proceeds were credited in bank accounts outside India on 28th March 24. Well, while applying rule 115, while applying the currency conversion rate, what is relevant is the date of sale or the month in which shares are sold or the asset is transferred. Here date of transfer is not given, but it is given that sale proceeds are credited in the bank account outside India on 28th March 24. So we presume that asset, that is shares, must have been sold in a nearby period only, just few days before that. 28th March the money is received, must have been sold somewhere on 27th March, 26th March, 25th March. That means sold in the month of March. Further, India has a DTAA with country A. India has a DTAA with country A, and the tax paid in country A is eligible for tax credit in India. That means tax credit method is being followed. Fiscal year for the income tax purpose is the same both in India and country A. That means financial year system 23-24 financial year, AY 24-25. Rate of tax is 20% in country A in respect of all incomes. Fantastic. Okay. So under tax credit method also, just like section 91, relief under section 91, unilateral relief, here also we will get the same answer or same amount what would have been allowable as a relief as a foreign tax credit under section 91. Here DTAA is there, the tax credit also will be of the same amount. Income tax was paid by Mahesh on 25th May 2024 for the incomes for the year ended 31st March 24 in country A. So in country A, whatever taxes being paid at the rate of 20%, for which we are going to get the credit in India under tax credit method, that also will have to be worked out in foreign currency. So first we will compute income in foreign country A, whereby we will not claim this 450 rupees of municipal tax and standard deduction, etc. because in that country it is not allowable. Not allowed is a deduction in country A. Standard deduction definitely not allowable. That is the concept prevailing only in India. Municipal tax, it is given not allowed in that country. It is given in bracket already here as we just read. We'll work out the income taxable in country A as per the taxation law of country A, on which we will apply 20% tax rate and we'll find out how much tax was being paid. That would be in foreign currency, which we will have to convert into Indian currency. That's it. Compute the total income and the net tax liability of Mahesh for the AY 24-25. Assume Mahesh pays tax under section 115 BSC. This is the most important part. It is clearly given that he is opting for 115 BSC and not for normal tax regime. TT buying rate, last paragraph, of $1 on various dates. TT buying rate means TT buying rate, exchange rate of State Bank of India. On various days, 29 February 2024 70 rupees, 28th March 24 70.50 rupees, 31st March 24 71 and 30th April 24 72, and on 25th May 2024 73 rupees. Complicated question. Most important part is a combination. What is the USP of this question? Combination of DTAA chapter and rule 115. Real life we face all this situation. Up till now whatever questions that we discussed had all the amounts given in terms of Indian rupees. So what to do about it? So question number 19. Question 19, we'll have to first find out how much is taxable in India, how much will be the income in India. Before that, we'll have to find out what currency conversion rates will have to be applied. So for currency conversion rates, we have rule 115. We have to apply telegraphic transfer buying rate TTBR of State Bank of India as on the specified date, and specified date will depend upon the type of income. We have 4 types of income from this country A. Which 4 incomes we have? We have number 1, business income. As far as business income is concerned, we have to apply the currency conversion rate TTBR as on the last day of the previous year. So PGBP income, if you recollect, income from house property, income from PGBP, last day of the previous year. Specified date would mean last date of the previous year. Previous year is 23-24, last date is 31st March 24. So for these 2 incomes, PGBP and IFHP, we will apply rate as on 31st March 24, which is 71 rupees. So PGBP income $25,000 into rupees 71 and as on 31st March 24, and house property income for Indian purpose in India, how much will be taxable? $4,500 minus $450 4050. Assuming this only becomes GAV in the absence of any further information about fair rent, municipal value, etc. Municipal tax we are subtracting. Balance is 4050, that becomes your NAV. NAV minus 30% standard deduction. 30% of 4050 would mean 1215. 1215 balance will be, so 4050 into 0.3 minus 4050, 2835. 2835 US dollar will be the IFHP income. IFHP income, but in terms of foreign currency. Into here which rate to be applied? Here also we'll have to apply the rate as on 31st March 2024, which is 71 rupees. Because for house property also we have to apply, HP also we have to apply rate as on the last day of the previous year, 71 rupees. Into 71, let's work it out. 2835 into 71 rupees, 2,01,285. 2,01,285 is the IFHP income in Indian rupees. As far as PGBP income was concerned, let's finish off the calculation of that part also. 25,000 into 71 will be 17,75,000. 17.75 lakh. Okay. So 3 points are done. Now fourth and fifth, dividend and STCG. Dividend is $10,000. For dividend, which rate to be applied? So let's go back to this. As far as dividend is concerned, last day of the month immediately preceding the month in which dividend is declared or distributed or paid. Last month immediately preceding the month of declaration. So dividend was declared in March 24. We'll have to apply the rate as on 29th February 24. 29th February 24 the rate was 70 rupees. 70 rupees. So it will be 7 lakh rupees. Dividend would be, in terms of Indian rupees, it will be 7 lakh. As far as short term capital gain is concerned, we don't have to calculate. Amount is directly given to us, 5,000 US dollar. It was credited in bank account on 28th March 24. So what is the rule for short term capital gain or for long term capital gain? Both the types of capital gain, last month rate as on last day of the month immediately preceding the month in which capital asset is transferred. Assuming it is transferred in March 2024, we'll have to go backwards and apply rate as on 29 February. 29 February it was 70 rupees. Again for this also will apply 70 rupees. It will be rupees 3,50,000. 3.5 lakh rupees. Okay. Foreign incomes are all ready in terms converted in terms of Indian rupee. We just had to calculate for IFHP. Here municipal tax is allowed. Standard deduction is also allowed even if opting for 115 BAC subsection 1A. And here from Indian income salary standard deduction is allowable. But this 1,80,000 SOP interest will not be allowed. So let's just calculate it out. Indian income and foreign income. So Indian income would be, salary would be 22.2 lakhs, 22.5 Indian rupees. Second point, interest is not allowed. Third point, IFOS. Now we'll have to go headwise. But right now I am not going headwise. I'll show it to you. Next ideally should be PGBP income and IFHP. IFHP, which is not Indian income, I would not title it as Indian income. Let's do one thing. Let me write it here only. Salary income 22.5. 22.5. Then we have IFHP. IFHP we have already computed. IFHP income was 2,01,285. So I'm writing this in proper language. 22,50,000 plus 2,01,000. How much was it? 2,01,285. Plus PGBP. PGBP income we have only from foreign country, country A. PGBP income was 17,75,000. 17,75,000. Then we have short term capital gain and then IFOS. Short term capital gain was 5,000 USD into 70 rupees was 3,50,000. 3,50,000. Short term capital gain is not arising or is not covered by section 111A. Therefore tax rate will not be 15%. It will be chargeable to tax as per normal rate. Everything till now is taxable as per normal rate. Then we have income from other sources. Under income from other source we have FD interest from India, 1 lakh, how much was it? 1,60,000. FD interest, 1,60,000. Then we have country A income, first income is done, second, third point is done, fourth, fifth is done, fourth is dividend, which is 7 lakhs. Dividend from country A, which is 7 lakhs, totaling to 8,60,000. Now let's take the total. 17,75,000 plus 3,50,000 plus 8,60,000, and first two incomes were left, 201,285 and 22,50,000. 54,36,285. 54, 36, 285. This is GTI as well as NTI. Under section 115 BAC, chapter 6A deductions are not allowed subject to some exception. This becomes final income. Okay. Now on this we'll have to calculate tax and find out how much is the average tax rate in India. Procedure that which we will be following is similar to the procedure which we are following for section 91 unilateral relief. Now tax on this, tax on 54, 36, 285. So if you recollect, according to section 115 BAC, the first 3 lakhs, 0 to 3 lakh no tax, 3 lakh to 6 lakhs 5%, 15,000, 6 lakhs to 9 lakhs 10%, there will be 30,000, 9 lakh to 12 lakh, this 3 lakh tax rate will be 15%, so 45,000, 12 lakh to 15 lakh tax rate is 20%, so tax will be 60,000, and above 15 lakhs, so 54 lakh 36 to 85 minus first 15 lakh, that will be 35 and 39, 39 lakh 36,000 to 85 at the rate of 30%. Less 15, 39, 36 into 0.3, 11, 80, 886, 11 lakh 80,000, 886 plus 45, 45, 90 plus this 1.5 lakh. So total would be 13 lakh 30,000, 886. Surcharge will be attracted. Answer yes, surcharge will be attracted because income is exceeding 50 lakhs. Therefore, surcharge will be at the rate of 10%. Don't forget that, many people forget surcharge. 10%, 1,33,089 plus 0.5 into 1.10, 1298,975. 1298,975 plus 4% health and education cess. Health and education cess would be plus 0.4. This 1298,975. 1298,975. I'm putting it in memory plus into 0.04. 51,959. Memory plus 1350,934. 1350,934. This is the net tax. Now the next step is average rate of tax. Average rate of tax would mean 1350,934. The tax divided by income. Income is 5436,285. 5436,285 into 100. Average rate of tax, this divided by 5436,285 into 100, 24.85. 24.85, and foreign tax rate is 20%. Foreign tax rate is not 20%. Foreign tax rate will have to work out. Effective tax rate is not 20%. The 20% is the rate given. However, the amount which is charged to tax is not 20% effectively. The amount which is charged to tax is different. See, it is given that foreign income has been taxed at a flat rate of 20% in country A. However, the amount which is charged to tax at 20% is not same as what we included in the NTI. How much income has been included? So 25,000 US dollar. PGBP income is 25,000. IFHP is 4,500. PGBP income will remain same. IFHP income will be 4,500. This 450 US dollar is not allowed in that country. Standard deduction is also not allowed. The amount chargeable to tax in that country is different. Dividend 10,000, short term capital gain 5,000. 10,000 dividend and 5,000 short term capital gain. The total income chargeable to tax is 15 plus 25, 40, 44,500. 44,500 US dollar. How much tax has been, when is the tax paid? Tax was paid on 25th May 2024 in country A. Country A also has the same financial year concept, financial year 23-24 April to March. Okay. Now how much tax must have been paid? Tax must have been paid at the rate of 20% of this, must have been 4450 plus this 8,900. 8,900 US dollar is the tax paid. Now this tax paid in US dollar will have to convert it into Indian rupees. Which rate would you apply? So answer, as per rule 115, taxes are paid on 25th May 2024. May 2024, a month prior to that. The last date of the month immediately preceding the month of payment. Tax was paid on 25th May 2024. Ignore the May month, take the preceding month April. April 30th, the rate was 72 rupees. 72 will have to be applied into rupees 72. 8,900 into 72, 6,40,800. 6,40,800 is a tax paid in terms of Indian rupees. Okay. Now we'll have to work out foreign income. So rather than percentage, this percentage was needed, average rate of tax. Now tax paid in foreign country. Tax paid in country A. How will we find out? So in terms of amount, it is 6,40,800. 6,40,800 divided by foreign income. Foreign income well, we need not find out percentage. What we can do is that tax paid in foreign country is 6,40,800. Straight away we will make comparison in terms of amount. 6,40,800, either this or tax paid on foreign income in India. Foreign income in India, tax paid in India on foreign income. How much is the foreign income and how much is the tax on that? Tax in terms of percentage it is 24.85%, but how much is the amount of income? Amount of income, so one PGBP income is foreign income, STCG, dividend and IFHP. So foreign income included here is 201, 285, 1775, 3,50,000 and 7 lakhs. So we'll just take the total of all these. 201, 285 plus 17,75,000 plus 3,50,000 plus 7 lakhs. 30,26,285. 30 lakh, how much was it? 30,26,285. 30,26,285 into this average tax rate 24.85. Tax paid on foreign income in India, this into 0.2485. 752,032. 752,032. Lower of the two. Lower of the two is 640,800. 640,800. This much will be allowed as a credit. Compute the total income and the net tax liability as per 115 BAC. So this much 640,800 is going to be allowed as a credit. How much is the tax in India? Tax in India is 13,50,934. 13,50,934 minus 640,800. How much was it? 13,50, 934 minus 640,800. 710,134. 7,10,134. is the final tax payable. This is the net tax liability. Let's check what is the answer. Okay, salary. You need to give the title and all. Mr. Mahesh, computation of total income and a tax liability of Mr. Mahesh. IFHP income 4500 minus 450 and rental income is taken as GAV in the absence of any clarification. 2835 after standard deduction. 201 285, our answer is correct. Self-occupied property interest is not allowed, that you will have to write a note. 201 285. PGBP income 1775. Capital gain 3,50,000 short term. Interest on bank FD 160 and 7 lakhs. 7 lakhs. Total is 860. 54 36 285. You are getting 54 36 285. Rounded off to 54 36 290. That's okay. No problem. Then tax is computed to be 1330 887. 1330 886 we calculated. 1 rupee calculation error, rounding of error. Okay. Then surcharge at the rate of 10%. Health and education says 1522 535. Ours is we goofed up in surcharge. 1298 975 into 0.04 91 959, correct. Okay, 1298 975, 1 minute. 1522 535. 1330 886 plus 133 089 plus 51 959. 15 15 934. Okay. Tax calculation is wrong. 15 15 934. 15 lakh 15,934 should be the tax. Our average tax rate would also be wrong. But that doesn't matter. Ultimately relief will be 6,40,800. Tax credit. 15 15 934 divided by 54,36,285 into 100. Average tax rate is 27.89. 27.89. Why I did not realize this calculation error? 27.89. Our final answer will be slightly different. $27.89 into 30,26,285 divided by 100. 843 894. 843 894 is the Indian tax. Tax in India on foreign income. So relief will be lower of the two, 6,40,800. 640,800 to be reduced from 15 15 934. 15 15 934. 15 15 934 minus 6,40,800. 875 134. 875 134. That was due to calculation error. Okay. Then foreign tax credit being lower of this 845 8 and 640 800. 847 572. 847, they are getting 847 because of rounding of error. That is okay, no problem. 640 800 will be allowed as a credit. Net tax liability 881 735. Again there is a difference. 1522 535 they are getting. We are getting 1515. 1180, 886. Have we made any mistake? Till here correct? What has institute people done? 1180, 887 into 1.10, 1298. Okay, so their total is wrong. Institute has made a mistake. See, 1380, 887 into 1.10 should be 1518, 975. Just a sec. We have made an error here. We have made one more totaling error. Be careful, the type of error which I am making, you should not be making. 1330, 886 into 1.10 would be 1463, 975. 1463, 975. Memory plus into 0.04. 58, 559. 58, 559 is a health and education cess. Total will be different. Average rate will also undergo changes. See, one small mistake can end up taking you a lot of time. Okay, this plus 1463, 975, 1522, 534. 1522, 934. 1522, 934. Average rate will also undergo changes. Everything will have to be changed. You know, small mistake. Conceptually our answer is correct, but a small mistake. 1522, 934. 1522, 934. 1522, 534. 534 divided by 54, 36, 285 into 100, 28%. Indian tax will also undergo changes on foreign income, and this final tax liability will also undergo changes into 28%. 30 lakh 26 285 into 0.28, 847 360. 847 360. Credit will be for 6,40,800, whichever is lower, minus 1522. So 1522, 934 minus 534 minus 640, 800. 1522, 534 minus 640, 800, 881, 734. 881, 734. This is the final tax payable, rounded off to 881, 740. That's it. With that, question number 19 comes to an end. Okay, now the last question, question number 20. Question number 20 is on APA, Advance Pricing Agreement. APA, Section 92CC, read with Rule 10F to Rule 10T. Rule 10F to Rule 10T, plus for rollback years, for rollback provision, Rule 10MA and Rule 10RA will be applicable. Okay, now we know pretty well that the rollback is possible for maximum 4 years preceding the year in which, or preceding the year from which the APA is applicable. Advance Pricing Agreement is the agreement between assessee and the CBDT, or rather any person who is subjected to transfer pricing and CBDT. ABC Private Limited of Bangalore is engaged in the manufacture of electronic goods and exporting the same to various associated and other enterprises, exporting it to associated enterprises as well as other enterprises across Southeast Asia. The report with respect to its international transactions with associated enterprise has been furnished for all the years. Report for international transaction has been furnished for all the years. That means they have complied with all the rules regulation. That means they have furnished CA report. The company has applied for APA in respect of the transaction with its associated enterprise. Company has applied for APA. Can Indian company apply? Answer is yes. Indian company can also apply. Foreign company can also apply. Non-resident, resident, anybody can apply. Application was filed on 15 February 2023. That means application was filed in financial year 2022-23. If application is filed in 22-23, it will be applicable, or the 5-year period for APA will be applicable from the next year onwards, because as per Rule 10I, the application for out of Rule 10F to Rule 10T, the application for APA has to be applied before the beginning of the previous year for which APA is sought. So if APA is to apply for financial year 23-24 onwards, then assessee will have to apply by latest by financial year 22-23 ending. Okay, so as per APA rules, Rule 10I, these are APA rules 10F to 10T. In that Rule 10I, application may be filed by any person referred to in Rule 10G before the first day of the previous year relevant to the first assessment year for which application is made, in case of transactions which are of a continuing nature, or application to be made before undertaking the transaction in respect of remaining transaction. So right now this one is applicable. Transactions are of a continuing nature and it is not a fresh international transaction to be entered into. So application has to be made before the first day of the previous year for which application is made. So if application is made for next year, application will have to be made in the current year. Or simple language, whenever application is made, APA will be applicable from the next year. Okay, so what is the language? 15 February 23 they applied, which was signed on 5th May 2023. When was it signed? That is immaterial. It was signed in financial year 23-24. That is immaterial. What is relevant is the date of making application. Okay. The company has also applied in respect of international transactions to which APA applies for rollback benefit. Rollback is possible for preceding 4 years, which was agreed and signed in January 24. The details of the status of income tax assessments are as follows. The rollback they applied in January 24, rollback will be applicable just because they applied for rollback in financial year 24-25 or rather 23-24 ending. Just because they applied in 23-24, that does not mean rollback will be 4 years preceding that. Coincidentally, this is the first year itself only. It will be, rollback will be applicable for 4 years prior to 23-24, the year from which APA becomes applicable. So as per Rule 10F to 10T plus 10MA and 10RA, 10MA and 10RA are for rollback. Application for APA is filed on 15 February 23, which is financial year 22-23. So APA will apply from 23-24, AY 24-25 as per Rule 10I. Financial year 23-24 it will become applicable. AY 24-25 will be the first year. If APA is for 5 years, then 1, 2, 3, 4, 5. These 5 assessment year APA will be applicable. Rollback will be for immediately preceding 4 previous year. 4, 3, 2, 1. APA will be from 2021 financial year. Right now we are talking in terms of assessment year. Here we talked in terms of assessment year, of financial year. Here we are talking in terms of assessment year. APA will be applicable from AY 24-25 financial year 23-24. Rollback will be applicable for AY 2021 till AY 23-24. Okay. Now what is it? It says details of the status of income tax assessments are as follows. So it says AY 18-19, the matter is pending before High Court. If the matter is pending before High Court, then technically APA cannot be applied, but APA rollback does not apply for AY 18-19 otherwise also. I showed it to you. AY 18-19 is beyond the 4-year period applicable for rollback. So for AY 18-19 rollback cannot be applied. Pending before High Court with regards to so and so, AY 19-20 and AY 20-21, there is no dispute and the assessments have been completed. So AY 19-20 again APA cannot be applied. Rollback cannot be applied. Rollback will be possible from AY 2021 and onwards. So AY 2021 no dispute is possible, no dispute is there. That means for AY 2021 rollback will be applicable. Then AY 21-22 assessment for AY 21-22 was completed by making reference to TPO, transfer pricing officer, under section 92 CA, who enhanced the arm's length price of the international transaction by rupees 500 lakhs. No problem. Then also AY 21-22 APA can be under rollback, APA can be applied. AY 22-23 ALP of international transaction was disputed before the tribunal. If it is disputed before tribunal, then assessee has to withdraw the appeal. If department has filed the appeal, department is supposed to withdraw. Assessee has filed, assessee is supposed to withdraw. However, tribunal has set aside the order for fresh consideration by AO in November 23. If tribunal ITAT had already decided, if tribunal had disposed of the case deciding the appeal, then in that case rollback cannot be applied for that year. However, here tribunal has passed the order but not disposing of the appeal, not deciding in the appeal. Tribunal has just set aside the matter and referred it back to AO for fresh consideration. So APA will be applicable for this year also under rollback. And AY 23-24, which is the last year out of 4 years, till AY 23-24 rollback can be applied. AY 23-24 income tax return was filed on 29 December 2023, that is beyond the due date of 30th November 2023. The due date for AY 23-24 for filing IT return would have been 30th November 23. If IT return is filed beyond time limit or CA report is not furnished, then in such situation rollback cannot be applied for that year. So out of these 4 years, or out of so many years given, AY 18-19 rollback cannot be applied because it is beyond 4 years. 19-20 also same thing, it's beyond 4 years. 20-21 can be applied if there is no dispute. 21-22 again the AO referred the matter to TPO, TPO enhanced it by 500 lakhs, 5 crore rupees, that's okay, APA can be applied, rollback can be applied. AY 22-23 matter was pending before tribunal, tribunal has set aside the order, referring it back to AO for fresh consideration, that means matter is now pending before AO. Rollback can be applied. But for AY 23-24 IT return is filed beyond due date, therefore for that year rollback cannot be applied. If the APA is applied, the ALP determined for AY 21-22, 21-22 is this, whereby AO referred to TPO and TPO enhanced the assessment by 500 lakhs or TPO enhanced the ALP by 500 lakhs. If ALP determined for AY 21-22, if APA is applied, then ALP determined for AY 21-22 would get enhanced by 300 lakhs, only 300 lakhs as against 500 lakhs originally determined by TPO. That's okay, no problem. As per Rule 10F to Rule 10T and Rule 10MA plus Rule 10RA, rollback cannot be applied in case if the rollback provisions, in case if APA for rollback years has the effect of reducing the income below the income at which it was returned by the assessee. Here, for example, assessee filed IT return showing net income or ALP of 3000 lakhs. 3000 lakhs. Based on TPO's order, it was enhanced by 500 lakhs. It was made 3500 lakhs. And as per if APA is applied, then instead of 500 lakh, it gets enhanced by only 300 lakhs. 3000 lakh plus 300 lakh, income will be 3300 lakh. No problem, this is absolutely fine. What is not permissible is that because of APA, income should not go below the level at which it was returned by assessee. So till the time it is enhanced by 300 lakh, no problem, APA can be applied for AY 21-22 also. Discuss the applicability of rollback agreement for various assessment years in case of ABC Private Limited. The answer, out of 4 years, it will be applicable, it will not be applicable for AY 18-19, 19-20, but will be applicable for AY 20-21, 21-22, 22-23, cannot be applied for AY 23-24. What is the solution? So first, institute has clarified about rollback. Rollback year means any previous year falling within the period not exceeding 4 previous years immediately preceding the first of the 5 consecutive previous years for which APA is applicable. Application may be filed at any time before the first date of the previous year. That means if application is made on 15th February 23, financial year 22-23, then APA will be applicable from financial year 23-24, AY 24-25. In the present case, applicant ABC Private Limited has made an application and also opted for rollback provision. APA apparently in respect of international transactions are of continuing nature. Accordingly, APA application filed on 15 February 23 would be in respect of 5 previous years beginning with previous year 23-24, AY 24-25. Consequently, APA entered by ABC Private Limited can provide for determining APA in relation to transactions entered into during rollback years from AY 2021 till AY 23-24. 2021, 21-22, 22-23, 23-24, subject to satisfaction of certain conditions. One of the conditions is that CA report should have been furnished for all these 4 years. IT return should have been filed for all these 4 years within the time limit. 18-19 and AY 19-20 fall beyond the 4-year period. Therefore, assessee cannot avail rollback for these 2 years. AY 2021 till 23-24, applicability of rollback provision would be as follows. For 2021 rollback, yes, possible, because there is no dispute. For AY 21-22 also yes, even though as per APA or as per rollback provision, the income which was enhanced by TPO by 500 lakh, instead of 500 lakh, income will now be enhanced by 300 lakh. Rollback provisions are applicable even if ALP adjustment was reduced to addition of 300 lakhs as against addition of 500 lakhs originally determined by TPO. It's just that since reduction in the amount of ALP does not result in reducing the total income or increasing the total loss as declared in the return of income. Income should not reduce below 3000 lakhs as per our example. For AY 22-23, yes, rollback applicable. If the matter was pending before tribunal, assessee would have to withdraw the appeal from tribunal. But if tribunal had already decided the matter, then rollback would not be applicable for this year. But here, ITAT has not decided. ITAT has only set aside the order for fresh consideration. Matter has not yet reached finality. AY 23-24, rollback not possible. Why? Because IT return was filed belatedly. With that, question number 20 is over. Now I am taking you backwards. 2 questions are pending. Question number 14 and 15. I am jumping to question number 15 now. Question 15 is here. Question 15, friends, is on capital gain. Capital gain, calculation of capital gain arising on transfer of units of mutual fund. On mutual fund units. Now apart from that, there is an exemption under section 54F also. 54F. And not only that, there is a new concept introduced with effect from AY 24-25 about specified mutual fund given in section 50AA. So let's try to understand. Mr. Sanjay is resident in India aged 55 years. That means below senior citizen age. However, here tax is not to be computed. Resident, he had impressive investment portfolio in various mutual funds. He redeemed his entire mutual fund investment portfolio and bought a villa in Lonavala for rupees 2 crore to spend rest of his life there. Amendments carried out in section 54F that if you are selling any asset other than residential house and buying a residential house, then the investment in the residential house, new residential house, should not be more than 10 crore. Any investment in a new residential house exceeding 10 crore will have to be ignored. Here investment is only 2 crore, therefore that point newly introduced will not apply. Details of mutual funds are as under. He has got types of mutual fund 1, 2, 3 and 4. 4 types of mutual funds. Date of investment, date of redemption. You will have to work out whether long term or short term, amount invested in lakhs and amount redeemed in lakhs. Okay, so this column minus this column will give you capital gain amount if indexation not to be applied. So let's first work out of these which of them are equity oriented, which of them are non-equity oriented. So understand, if the fund is non-equity oriented, then in order to become long term, the period of holding, if it is non-equity, period of holding should be more than 36 months. Then only it will be called as long term. However, if it is equity oriented fund, then it will become long term in just 12 months. After expiry of 12 months, period of holding should be more than 12 months. After expiry of 12 months, it will become long term. However, as per section 50AA, if the investment in equity shares, investment of the mutual fund is less than 35%, plus investments are made by assessee, individual investor, on or after 1st April 2023, then such units will be called as specified mutual fund units, and accordingly, irrespective of the period of holding, it will always be short term. Always short term, indexation will never be allowable. Short term capital asset, even if period of holding is much more than 36 months. Naturally, if it is equity oriented, that means investment is more than 65% out of total investable funds. More than 65% of the funds are invested in equity, or that is how it is called equity oriented fund. Up to 65% is invested, it will be non-equity, and within non-equity oriented, if less than 35% is invested in equity shares, it will be called as specified mutual fund. Concept of specified mutual fund has been introduced recently with effect from financial year 23-24. Your attempt onwards, yours would be the first attempt. Okay, so 4 funds are given one by one. We'll be discussing. Further, it says funds which are stated at 1 and 2 have invested 30% of their proceeds in equity shares of domestic companies. Okay, only 30%, that means less than 35%. So first 2 funds are not only non-equity oriented fund, they are specified fund also. These 2 are specified fund. Therefore, period of holding not to be seen. Specified fund, specified fund. As per section 50AA, period of holding not to be seen, they will always be short term, indexation will never be allowable. Okay, and funds stated at 3 and 4 have invested 70% of their proceeds in equity shares of domestic companies. That means fund number 3 and 4 are equity oriented. Equity oriented fund. You can write it down, equity oriented, equity oriented. If it is equity oriented, no, then another thing, not only this benefit that it will become long term in just 12 months period, plus if it is short term, then section 111A benefit is available. If it is long term, then section 112A benefit is available. First 1 lakh will not be taxable, anything above 1 lakh will be taxable at 10% rate. First 1 lakh is not exempt, it's just that the tax rate applicable to first 1 lakh of LTCG will be 0%. Okay. Then the investment pattern of funds, actually it should be more than 65% on an average. So as far as average is concerned, they are saying the investment pattern of these funds remained unchanged over all the years. That means it was 70% all throughout the year. STT is paid at the time of acquisition as well as at the time of redemption of mutual fund. Since STT is paid, therefore 111A and section 112A benefit available. You are required to compute the amount of capital gain chargeable to tax in the hands of Mr. Sanjay for AY 24-25, then CII numbers are given. So let's first work out whether period of holding is, whether these are long term or short term. So as far as first 2 funds are concerned, it doesn't matter long term, short term, period of holding not to be checked because they are specified fund. Here, date of investment and date of redemption not to be seen. The difference between the two will be the short term capital gain always. So here amount redeemed is 140 minus 120, 20 lakh will be the short term capital gain, STCG, and here 50 minus 46, 4 lakh rupee will be the short term capital gain. Okay, so this much part is done. If you accidentally end up applying, so out of these 2 funds, which of them is long term? So here period of holding is more than 3 years. If you apply long term provisions and you take indexation, then there will be problem. Okay, then second one is short term, but we have to take it as short term only. Okay, then third and fourth. Third one, ABD mid cap fund. Here investments are made on 2nd December 2022 and redeemed on 5th July 23. Is it more than 1 year? Answer, it is December 22 to July 23, hardly 8 or 9 months. So here it will be short term. This is short term capital asset. Gain will be 118 minus 115, 3 lakh will be the gain. And here SBA growth fund, 8th November 2021 till 12th December 2023. 21 to 23, if the period of holding, since it is equity oriented, period of holding should be more than 12 months in order to be called as long term. So here period of holding is 13 months. Therefore this will be long term. However, because of section 112A, indexation will not be allowed. Gain will be 120 minus 110, gain will be 10 lakh. Okay. Then you are required to compute capital gain. Don't forget that he has purchased one villa also. Villa at Lonavala for 2 crore rupees, which entitles the assessee to claim exemption under section 54F. However, 54F exemption is available only with regards to long-term capital gain. But in order to be called as specified mutual fund, section 50AA, there are two conditions. Investment in equity shares is less than 35% or up to 35% outside, plus investment are made on or after 1st April 23. So out of first two funds, second fund investment is made on or after 1st April 2023. This is specified fund. But BLR growth fund, first fund investment is made on 3rd April 2020. Therefore, it will not be specified fund. Are you understanding this? Agreed. Out of two conditions given in section 50AA, first condition is satisfied that the investment is not more than 35% in equity shares, but investment is not made on or after 1st April 23. Investments were made on 3rd April 2020. Therefore, it cannot be called as a specified fund. It will just be called as simple non-equity oriented fund. If the period of holding is more than 3 years, then it will be long term. So just calculate period of holding is 3 years and 2 months. Therefore, this will not be short term, this will be long term. And here indexation benefit will be allowable. The amount will not be 20 lakh, amount will have to be calculated. Another thing, section 54F exemption with regards to purchase of villa at Lonavala is available only with regards to long-term capital gain. So here long-term capital gain will be working out, calculating it. There are two long-term capital gains. One is arising in fund number 4 and one is arising in fund number 1. Okay, so let's just calculate it out. For fund number 1, investments were made in financial year 2021. So CII number of 2021 will have to be taken into account and CII number of 2324. So we'll have to calculate it out. For 2021, CII number is 301 and for current year it is 348. 301 and 348. So here sale consideration is 140 lakhs minus index cost of acquisition will be, cost of acquisition is 120 lakhs multiplied by 348 divided by 301. 348 is a CII number of the current year, 301 is a CII number of the year of acquisition. We'll have to calculate it out. 120, 1 crore 20 lakh divided by 301 into 348. 1 crore 38 lakh 73,754. 138 73 754. 138 73 754. Balance will be the long-term capital gain. A negligible amount I can see here, minus 1 crore 40 lakhs, 1 lakh 26,246, 126,246, 126,246 LTCG. This LTCG will be eligible for section 54F exemption, and here for fund number 4, indexation is not allowed. LTCG will be straight away 10 lakhs. So, the capital gain amount from fund number 1. So, for fund number 1 and 2, it is debt oriented, but long term is appearing in fund number 1 and fund number 4. For fund number 1, the LTCG amount is 126. How much was it? 126,246, and for fund number 4 there is a LTCG covered under section 112A without indexation, but we are not being asked to compute the tax. How much was it? 10 lakhs. Total 11 lakh 26,246. This is the amount of LTCG. And as far as LTCG, and as far as fund number 2, and fund number 3 are concerned, there will be short-term capital gain. Short-term. How much? Indexation is not possible. Short-term capital gain of 4 lakhs and short-term capital gain of 3 lakhs. 4 lakhs, 3 lakhs, totaling to 7 lakhs. Total capital gain is 18,26,246. From here we are going to claim exemption under section 54F. 54F is available proportionately. In order to claim exemption of full amount of 11,26,246, in order to claim full exemption, the amount that needs to be invested in acquiring the villa should be equal to the sale consideration. How much is the sale consideration? Fund 1 and Fund 2, Fund 1 and Fund 4. Fund 1 sale consideration is 140 lakhs and fund number 4 it is 120 lakhs. 140 plus 120, in order to claim full exemption of 11,26,246, amount that needs to be invested in a villa should be 260 lakhs. However, the amount invested is only 200 lakhs. Therefore, entire 11,26,246 cannot be claimed exempt. Which one? How much exemption? Exemption will have to be computed in a proportionate manner, which we will have to work out. However, which one is better to claim exemption first on? Exemption cannot be claimed on both the capital gains. It is advisable to claim exemption on fund number 4 capital gain first, because here the sale consideration is 120 lakh and the capital gain is 10 lakh. By investing 120 lakh, you get exemption of 10 lakh. But as far as fund 1 is concerned, the sale consideration is 140 lakh and the capital gain is hardly 1,26,000. By investing 140 lakh, you get exemption of 1.26 lakhs, and fund number 4, by investing 120 lakh, you get exemption of 10 lakh. So advisable to claim exemption with regards to fund number 4. First, amount of capital gain is 10 lakh into amount invested is 120, sale consideration is also 120, full 10 lakh rupee will be exempt. And as far as investment out of fund number 1 is concerned, to which we are giving second priority, the exemption would be not entire 1,26,246. Exemption will have to be calculated. 126,246 multiplied by amount invested divided by the amount of sale consideration. Sale consideration is 140 lakh. However, entire 140 is not invested. As we discussed here, total investment is 2 crore out of total sale consideration of long-term capital asset of 2 crore 60 lakh. So out of 2 crore rupees of investment in the villa, 1 crore 20 lakh is exhausted by fund number 4. The balance left out of 2 crore investment, 1 crore 20 lakh is already exhausted. Balance 80 lakhs is left out. So exemption will be 126,246 into 80 lakhs divided by 140 lakhs, which will have to compute proportionately. Out of 2 crore of investment, 1 crore 20 lakh rupees is already exhausted by fund number 4. Investment out of fund number 4 is given first priority because exemption will be higher. So 126,246 into 8 divided by 14. Exemption will be 72,141. 72,141. Balance capital gain will be taxable. We don't need to bifurcate how much is short term, how much is long term. 18,26,246 minus 10 lakhs minus 72,141. 754,105 is the taxable capital gain. 754,105. Let's check what's the institute's answer. So redemption of BLR growth fund, that is fund number 1. Full value of sale consideration is 1 crore 40 lakhs. Index cost of acquisition is 138,73,754. So 126,246 is the LTCG. Here it is LTCG because debt fund, it is a debt fund, it is non-equity oriented fund. Not more than 65% are invested in equity shares. It was held by Mr. Sanjay for more than 36 months immediately preceding the date of transfer. So this is correct. Then second fund is a specified fund less than 35% are invested, only 30% is invested in equity shares of company and the investment is made on or after 1st April 23. So here indexation not allowed, and otherwise also this is short term. So this minus cost of acquisition 4 lakh will be the short term capital gain. Our answer is correct. Acquired on or after 1st April 23 and not more than 35% are invested in equity shares, then as per section 50AA it will be called as a specified fund. Then third fund, redemption of ABD mid-cap. ABD mid-cap is, here how much was the period of holding? Period of holding, it is a short term capital asset, period of holding is hardly 7-8 months. So 1 crore 18 lakh minus 1 crore 15 lakh cost of acquisition, 3 lakh is the STCG. Our answer is correct. Then last fund, which is long term, period of holding is more than 12 months, it is a long term asset. However, because of section 112A, since STT has been paid and it is equity oriented fund, therefore indexation benefit will not be allowed. 10 lakh will be the LTCG. LTCG will be 1 crore 20 lakh minus 1 crore 10 lakh, 10 lakh will be the LTCG. Total capital gain is 1826 246. Our answer was also 1826 246. Till here correct. Further, now exemption under section 54. First you merge all the capital gains, long term, short term, everything combined together. Now exemption under section 54F will be claimed only with regards to long term asset. Okay, so exemption number 1 with regards to funds invested out of fund number 1. 10 lakh is the capital gain. 1 crore 20 lakh is invested out of 1 crore 20 lakh of net sale consideration, therefore full 10 lakh exempt. But with regards to fund number 3, fund number 4, which is long term, out of 1 crore 20 lakh, how much is invested? Entire 1 crore 20 lakh, that has been taken care of. Now fund number 1, 1 crore 40 lakh is invested, but we cannot take into account entire 1 crore 40 lakh. If you take into account entire 1 crore 40 lakh, then your total investment in a villa at Lonavala should be 2 crore 60 lakh, but the investment is of 2 crore. So 1,26,246 LTCG multiplied by 80 lakh. 80 lakh is 2 crore of total investment minus 1 crore 20 lakh exhausted by fund number 4 divided by 1 crore 40 lakh. 72,141 proportionate exemption. Capital gain taxable will be 754,105. Our answers are correct. With that, question number 15 comes to an end. Going backwards, last question, question number 14, which is on minimum alternate tax. So question number 14 is here. Question 14, friends, is on minimum alternate tax, section 115JB, applicable to companies. Shubh Fragrance Limited, established in 2015, is engaged in the manufacturing and selling of pharmaceutical products. Now, as far as minimum alternate tax is concerned, which is applicable to companies, company may opt for section 115BAA or 115BAB. Since it's a manufacturing company, 115BAB is possible, 15% tax rate. But for claiming 115BAB, company should have been incorporated on or after 1st April 2020. Now here company is established in 2015, therefore 115BAB not possible. 115BAB not possible. So as far as regular income is concerned, the tax rate could be 30% or tax rate could be 25% if the turnover 2 years back did not exceed 400 crore, or company might opt for 115BAA, tax rate can be 22% plus compulsory surcharge 10%. But if company opts for 115BAA, then MAT is not applicable. Therefore, institute will not give you question like this. So tax rate applicable could be 30 or 25. 115BAB not possible. BAA company might not have opted. If company has opted, question comes to an end. Okay, Shubh Fragrance Limited, established in 2015, is engaged in manufacturing and selling of pharmaceutical products. The net profit of the company as per P&L account for the year ended 31st March 24 is 900 lakhs. After debiting crediting the following items. Okay, so net profit is already given to us, but it is after debiting crediting following item. How many items are there? 1, 2, 3, 4, 5, 6, 7, 8 items are there plus some additional information, 3 points, total 11 adjustments are given. What are we being asked to compute? Compute the total income and the tax liability computed in the most beneficial manner for the AY 24-25. So we'll have to work out which is more beneficial. The total turnover of the company for the previous year 21-22 was 282 crore and for the financial year 22-23 was 405 crore. One is more than 400 crore, one is less than 400 crore. Which turnover do we have to pick up? We have to pick up turnover 2 years back. Current year is 23-24. So we have to ignore 23-24. We have to take turnover 2 years back, 22-23, 21-22. We have to take turnover of 21-22 which is 282 crore, therefore 25% tax rate is possible. Turnover of 22-23 is not to be seen, not to be taken into account. Company has a MAT credit of 20 lakh rupees for the AY 16-17. Now we have to compute tax liability in the most beneficial manner. So we will have to work out if company opts for 115BAA 22% tax rate, then what will happen? But then in that case MAT credit will lapse. MAT credit brought forward will totally lapse. So one will have to be careful, we'll have to make double calculation and find out and make comparison and find out whether 115BAA would be more beneficial or normal tax rate of 25% would be more beneficial. Okay, let's just quickly calculate it out. So net profit, but before that, did we finish this paragraph? Okay, the book profit computed for AY 24-25 is 1520 lakhs, 15 crore 20 lakh. Wow, book profit is readily given to us. Book profit into 18.5 or 15, answer 15%. 18.5% is in AMT, here it is 15%. That will calculate, that will be company's MAT liability. However, as far as regular tax is concerned, we'll have to calculate it out. 900 lakh is the net profit after debiting, crediting following items. So first point is payment of 50 lakh rupees in the month of November 23 to a foreign company for obtaining know-how. Know-how is a capital asset, intangible asset for a product launched in the month of December 23. 900 lakh of profit is worked out after debiting 50 lakh rupees. Book profit is already computed, so we don't have to bother about that. We just have to calculate correct net profit once again. 50 lakh is towards purchase of capital asset called know-how, which is not allowed, wrongly debited. So we will have to add back 50 lakh rupees. What will be the effect? 50 lakh rupees will have to be added back. Not only 50 lakhs to be added back, but we will have to compute depreciation also. This asset is not recognized as an asset, it is debited to P&L, that means it is considered as a revenue item. So company must not have claimed depreciation on that. So depreciation on this will be at the rate of 25% intangible asset, but it is acquired in the month of November 23. November 23, that means put to use for less than 180 days. November, December, January, February, March, hardly 150 days. Therefore, depreciation on the same will have to be computed. Depreciation at the rate of 25% into half of 50 lakh into 50 lakh, depreciation will be 6.25 lakhs. Depreciation will have to be reduced, 50 lakh will have to be added back. Electricity charges of 7 lakhs for the month of March 24 were unpaid up to the due date of filing IT return. Now, 9 expenditures unpaid up to the due date of filing IT return are not allowed as a deduction as per section 43B. As per section 43B, but 43B does not apply on electricity charges. Therefore, this particular point will have no effect. You can write no effect. Second point is done. Third, loss of 4 lakh rupees due to hedging contract against future price fluctuations in respect of import of raw material used in the course of manufacturing. Now this loss in hedging contract, due to if the hedging contract is in connection with raw material, then it is certainly allowed as a deduction as per ICDS also, income computation and disclosure standard, as well as per section 36(1). This loss is allowed, therefore no effect. No effect. Depreciation charged to statement of P&L was 45 lakh. This is depreciation as per books of account. Add back 45 lakh. 45 to be added back entirely. 50 lakh will be adding back in point number 1. 45 lakh to be added back in point number 4. 11 adjustments, we are done with 4. Fifth one, loss of 2 lakh rupees, that means must have been debited again from hedging contract entered into for mitigating the loss arising due to fluctuation in foreign currency, foreign currency payment towards an imported machinery purchased from Japan for rupees 65 lakh, which was installed in the month of December 23. Now this 2 lakh rupees is again loss due to hedging contract, but it is not revenue in nature, it is capital in nature. The one which was given in point number 3 was with regards to raw material. Therefore, it is allowed to be debited to P&L. But the loss which is given in point number 5 from hedging contract is for purchase of machinery, imported machinery from Japan. Therefore, this 2 lakh rupees will be governed by section 43A. As per section 43A, it needs to be added to the cost of the asset. Actual cost of the asset from 65 lakh will become 67 lakhs. So this has been debited to P&L account. This needs to be added back. First, to add back this 2 lakh rupees, add back, it is a loss of 2 lakh, must have been debited to P&L. Therefore, you first add back. Now second effect will be depreciation. Depreciation on that 2 lakh rupees. This asset was put to use in December 2023. It was installed in December 23. That means less than 180 days. Depreciation would be, or rather depreciation on this plant machinery would be at the rate of 15% into half. Why half? Because put to use for less than 180 days. Half into 2 lakh rupees, which will be 15,000. Now we don't know whether depreciation on this 65 lakhs has been claimed or not. If depreciation on the 65 lakh is not claimed, 65 is not debited to P&L, but whether depreciation on 65 is claimed or not, we don't know. Since associate is into manufacturing, therefore given in the second line, therefore additional depreciation will also be allowed. Additional depreciation will be at the rate of 20% into half. This will also be allowed at half the rate into 2 lakh rupees. So it will be 20,000. 15,000 depre, normal depre, 20,000 additional depre. However, let me warn you, additional depre is not allowed if opted for 115 BAA. Under section 115 BAA. Company being a manufacturing company, in spite of being a manufacturing company, cannot opt for 115 BAB because company was already established in the year 2015. But 115 BAA 22% tax rate can be opted for. If this rate is opted, then MAT will not apply and MAT credit brought forward 20 lakh, that will also lapse. So we will have to make comparison and find out, and then additional depreciation 20,000 will not be allowed. This was the story of depre and additional depre on that 2 lakh rupees as per section 43A, which is to be added to the actual cost or added to the WDV. As far as the 65 lakhs is concerned, we don't know, we will wait for the information. 6.20 lakhs received. Now this must have been credited to P&L. This is received from Z Limited under an agreement in the form of non-compete fees NCF for not carrying out any business in a particular product. Now 20 lakh rupees is a non-compete fees. This is chargeable to tax under the PGBP only, and therefore it is credited. It is chargeable as per section 28 clause 5A, which is a charging section of PGBP, and it is credited. It should have been credited, it has been credited, therefore no effect. 7 point, advance received amounting to 20 lakh rupees on proposed sale of land which is forfeited. This is story of advance forfeited due to non-receipt of balance amount of 70 lakhs on time as per terms of the agreement. The land was purchased during financial year 1920. Land was purchased in 1920, but here the sale has not taken place, therefore we don't have to calculate capital gain. However, capital gain is not required, but advance forfeited 20 lakh rupees, if forfeited on or after 1st April 2014, then it is no more to be considered under the capital gain. It will be taxable under income from other sources. But it's been wrongly credited to P&L. So in PGBP head, what do you do? PGBP head, you remove it. 20 lakh is credited. Now you subtract 20 lakh. And this 20 lakh will be chargeable to tax under the income from other sources. IFO's head, add back 20 lakhs. Add 20 lakh. Eventually it will have no effect. Both PGBP IFOs are taxable at same rate, but this is a correct treatment. You need to write reasons for this. Excess on sale of unlisted shares 15 lakh sold on 15 February 24. If it is short term capital gain, then amount will be 15 lakh. It is excess on sale of unlisted shares. This should go under the head capital gain. It is credited to P&L. So under the head PGBP, remove this. PGBP minus 15 lakh. And in capital gain head, we don't know whether this is short term capital gain or long term capital gain. If it is long term, then indexation will have to be taken into account. So capital gain head, we are keeping it pending. Additional information, normal depreciation allowable as per Income Tax Act is 35 lakh. So 35 lakh to be reduced. 35 to be reduced. How much was the depreciation as per books of accounts? Fourth point, depreciation as per books of accounts was 45 lakhs, which we added back, and 35 lakh we are subtracting. However, we need to check whether this 35 lakh already includes depreciation on that know-how given in first point. Depreciation was 6.25 lakhs. Whether this is covered in 35 lakhs or not, and whether this point number 5, 2 lakh rupees loss on hedging contract, that is which we are adding back to the cost of the plant machinery of 65 lakh, depreciation on that is also taken into account or not, we don't know. So let's read further. Depreciation, if any, required to be computed on the amount debited or credited to statement of P&L is not included. That means apart from this 35, we will also have to claim 6.25 lakh on know-how. We will also have to claim depre and additional depre on 67 lakhs. So amount debited credited to P&L on that depreciation has not been claimed. 35 lakh does not include that. So 67 lakh into 15% into half, into 15% into half, there will be depreciation, and additional depreciation will be 67 into 20 into half, put to use for less than 180 days. This much extra will have to be calculated. The unlisted shares were acquired on 29th March 2021, sold on 15 February 24. That means sold. Okay, as far as unlisted shares are concerned, they become long term not in 3 years, they become long term in 2 years. If you recollect, period of holding should be more than 2 years or more than 24 months in order to be called a long term. So these are definitely long term capital asset. Indexation will have to be applied. Acquired for 80 lakh rupees, excess is 15, that means sale consideration must have been 95 lakhs. Then only as per books of accounts, capital gain must be or excess must be 15 lakhs because the sale consideration must have been 95 lakhs. Cost inflation index for financial year 1920 is 289, that is for land which we don't require. 2021 for shares 301, and current year it is 348. That's it. Let's calculate it out quickly. So this is question number 14 on minimum alternate tax. The net profit already given to us is how much? 900 lakhs. 900 lakhs. Okay, in that first point 50 lakh add back. What is the treatment? 50 lakh. So I am not writing the particulars. 50 lakh. Why is it to be added back? Because it is a capital expenditure, cannot be debited. Depreciation on the same we will take care later. So this 50 lakh is done. Electricity charges, no effect. So second point, no effect. Then third point, loss of 4 lakhs from hedging contract for raw material, therefore no effect. Fourth point, depreciation charge to statement of P&L is 45. So 45 depreciation to be added back. Books of account depreciation. Then fifth point, loss of 2 lakhs. 2 lakhs to be added back because this is the hedging contract loss with regards to acquisition of plant machinery. 2 lakh add back. Depre and additional depre on that 2 lakh as well as 65 lakhs has not been given effect, which we will take care of. 20 lakh receipt from Z Limited, no effect because that is non-compete fees. Okay, then 7 point, advance 20 lakh received, charged to P&L, in the sense credited to P&L, 20 lakh rupees should go under the IFOS. So 20 lakh needs to be reduced and 20 lakh will be adding back under IFOS. Income from other sources, we will add 20 lakhs. Before that capital gain will come. Okay, then This is done. Excess on sale of unlisted shares. This will have to compute. It will be long-term capital gain. Long-term capital gain on shares. Unlisted shares. Unlisted. Sale consideration is 95 lakhs less index cost of acquisition. For index cost of acquisition is 80 lakhs into 348, the CI number of the current year, divided by CI number of the year of acquisition, which is 301, divided by 301. We'll have to calculate it out. 80 into 348 divided by 301. 92 lakh 49,169. 92,49,169. 92,49,169. LTCG amount 92,49,169 less 95 lakhs 2,50,831. 2,50,000. This will have to write full amount. 250,831. Okay, so this point is done. This is done. Okay, but this capital gain is a long-term capital gain, will have to be charged to tax at 20% rate. At 20% rate. As far as unlisted shares are concerned, assessee cannot opt for 10% without indexation. That benefit is only for listed securities other than units and zero coupon bond. 10% without indexation not possible. Tax rate will be 20% as per section 112. Whether assessee company opts for 115BAA or does not opt for 115BAA, tax rate on LTCG will remain same. That's it. Only depreciation is left out. Depreciation will have to calculate 35 lakhs and further depreciation. So depreciation as per IT Act is 35 lakhs on technical know-how it will be 6.25 lakhs, and on plant machinery it will be depre and additional depre. We'll have to calculate separately. Depre, additional depre. Additional depreciation will have to be computed separately for a reason that additional depre is not allowable if opting for 115BAA. So when we apply 115BAA, we'll have to add this back. So depreciation will be 67, entire 67 into 15% into half. And additional depre will be 67 into 20% into half. So 67 lakhs into 0.075. 5,02,500. 5,02,500, and additional depre will be 10%, 6,70,000 plus 6,70,000 plus 6,25,000 plus 35 lakhs 52,97,500. 52,97,500 is the total depre. Okay, let's calculate now. So PGBP will finish first and then we'll take care of IFOS. IFOS is 20 lakhs. I'll write it separately here. Income from other sources 20 lakhs. So PGBP income, let's first calculate. 52,97,500 is to be subtracted. 900 plus 50 plus 45 is 995 plus 2 997 minus 20 977. 977 lakhs. 997 9 crore 77 lakh minus 52 97 500 924,02,500. 924,02500 is your PGBP income. 9 crore 24 lakh 02500 plus LTCG 2,50,831. You'll have to write reasons for everything, and plus 20 lakhs 9 crore 46 lakhs 53,331. 9 crore 46 lakhs 53,331. 946 53 331. 946 53 331. Okay. Now on this, if associate company opts for 115 BAA, in the meantime let's check our answers. 50 lakh added, electricity bill no effect, loss due to hedging no effect, then depreciation as per books 45 add back, loss from hedging add back for plant machinery 9 crore 97 lakhs, then non-compete fees no effect, advance forfeited reduce, profit on sale of unlisted shares that also needs to be reduced. I think this we forgot to reduce. We forgot to reduce 15 lakhs. So this will become, PGBP income will become 909 and total income will become 931. Then 35 lakh is a depreciation, 65 plus 2 67 lakh, 67 lakh will have 502,500 as a depreciation, 6 lakh 70,000 additional depreciation, 6 lakhs 25,000 depreciation on technical know-how, 52 97 500, 909 02 500. 909 02 500 PGBP income is correct. Then capital gain 258.31, 258.31 is correct. Then IFOS 20 lakh, total 931 53 331. 931 53 331. Okay, now remaining part I'll show you directly from RTP. Remaining part is about computation of tax. As far as tax computation is concerned, 258.31 will be taxed at the rate of 20% under section 112. 258.31 into 0.2, 50,166. Balance income 931 53 331 minus 258.31. Balance income is 929 02 500. 929 02 500. This income may be taxed either at 25% rate. If company opts for 115 BAA, then income will not be 929 02 500. Income will be 929 02 500 plus additional depreciation. Additional depreciation of 6,70,000, which is not allowable under section 115 BAA, plus 6,70,000, 935 72 500. 935 72 500. But this will be taxed at 22% rate plus compulsory surcharge 10%. And here 929 02 500 will be taxed at 25% rate. Two crore 5 lakh 85 950. 2 crore 5 lakh 85 950 is the tax as per 115 BAA plus compulsory surcharge which I am adding. And in case if company decides to go for normal tax rate, then 9 crore 29 lakh 02 500 into 0.25, 232 25 625. 232 25 625. Plus here surcharge will be attracted or not? Here surcharge will be attracted because income is more than 1 crore but income is less than 10 crore. Therefore surcharge, this is the NTI. Surcharge will be how much? Surcharge will be at the rate of 7%. This I am putting into memory into 0.07. 1625 794. 1625 794 rounded off figure. 248 51 419. 248 51 419. Here surcharge will be 20,58,595. So 2 crore 5,85,950 into 1.10. 2 crore 26 lakhs 44,545. 226 44. How much was it? 545. Let's check whether calculation is correct or not. So tax on this is 50,166 plus if 25% is opted for plus surcharge 7%, tax will be plus health and education says we forgot. Balance income 9 crore 29 lakh 02,500 into 25%. 232 25 625. This is correct. Total is 232. Oh, surcharge we should have added after adding this. Okay, any which ways, total of these two or total of this and this plus surcharge. So in that case, what will be more beneficial? Understand. So my calculation mistake is there, so I am not rectifying it. Let's finish it off. I hope you have understood this. So first you take the total of tax on long-term capital gain and tax at the rate of 25%. Total is this much plus surcharge will be attracted 7% because income is more than 1 crore up to 10 crore. Total this much plus health and education says total tax will be 2 crore 59 lakh if normal provisions are opted for, versus AMT versus MAT 1520 lakh into 15%. 1520 into 0.15. 2 crore 28 lakh plus surcharge. Surcharge will be attracted, but here surcharge will be 12%. Here surcharge will be 12% because book profit is more than 10 crore. It is 1,520 lakh, that is 15 crore 20 lakh into 1.04. 265.5744 lakhs. $265,5744. So in case if normal tax is opted for, then which one is higher, this one or this one? Naturally MAT is higher. However, MAT is higher. In such situation, MAT will be payable. There will be extra credit generated. 20 lakh credit is brought forward, but that credit will have to be carried forward. But in case if company decides to opt for, there will be further MAT credit of 656,140 plus that 20 lakh brought forward, everything will be carried forward. In case if they decide to opt for 115BAA, then effective tax rate will be 25.168%. but not on long-term capital gain. However, income will be this much. Additional depreciation will have to be added back because under 115BAA additional depreciation is not allowed. Tax rate on long-term capital gain will remain same, 20%. Tax will be 50,166. On remaining income at the rate of 22%, remaining income will be 9 crore 35 lakh 72,500. 9 crore 35 lakh 72,499 they are getting, 1 rupee difference. Total tax will be this much plus surcharge 10%, compulsory surcharge, plus health and education says total tax will be this much. However, 2 crore 36 lakhs is much lower than 2 crore 65 lakhs. the tax liability coming under 2 crore 65 lakh. MAT will not apply. However, in such situation, the MAT credit of 20 lakhs will lapse plus a fresh MAT credit which was getting generated in the current year, that would also lapse. 656 240 fresh MAT credit plus 20 lakh brought forward MAT credit, total 26 lakhs 56,140 will be the benefit which will be lapsing. However, company will have to take a call. Once it opts for 115BAA, it cannot reverse. It would not be eligible for balance 10% additional depreciation. Tax liability will be this much, which is lower than the tax liability under regular provisions. However, once 115BAA is opted for, company cannot go back to the normal. So what is beneficial that institute has not jumped to any conclusion? Suggestion is to evaluate both the options and take a call accordingly. 2 crore 36 lakhs 07 720 is a tax liability if 115BAA is opted for. On the other hand, 2 crore 65 lakhs something is a liability if they opt for normal provision. However, if they opt for this, then tax is less by around 29 lakhs. At the same time, they lose the benefit of 26 lakhs. 26 lakhs something. In that case, there is a negligible benefit of 3 lakh rupees still available. So it is advisable to opt for 115BAA. But institute has not given any conclusion. They've just stated it is up to company to take a call. That's it. With that, your RTP comes to an end.